our numbers or who's coming in, who's going out.
Oh, wait, Mireille, if you need help with webinars with your students, by all means, draw me in at any time.
Hey, okay, I can organize it. Yes, great, thank you.
Yeah, so any topics you want, let me know. I mean, you know the topics that.
Yes.
Very good.
Okay, thank you, Constantin.
Voilà. Okay, we give it a few more minutes. We're 20 so far, and we'll be starting. Berytech.
Hi, good morning, everyone. This is Rabia Faris.
Good morning, Rabia.
Good morning.
Hi.
Sabah, is the screen showing?
I'm seeing it.
It is, yes. Yes,
It is, okay, very good. All right, let's
Yes,
start.
Perfect.
Let's start. We're going to have a few more people joining in over the next few minutes. What we're going to do today, first of all, Sabah al-Khair, Ramadan Kareem to our Muslim friends. It's the first day today. We're hoping that you're all safe and healthy. Let me start by sharing a bit what we're going to cover. So you're all familiar with the investment readiness journey. I will just share one slide that a number of you have seen just to put things in perspective. But our focus today is going to be on what I believe is probably the most critical phase or phases that companies who are raising either debt or equity will have to go through. So the first phase is that we'll be discussing is the due diligence phase. And the second one is the term sheet negotiation. What we'll do is I'll provide you with an overview on the different phases just to make sure that we all speak the same language. I will share with you the framework. So the slides will include different frameworks that you will be using. And I'm going to position myself as the investor. So this is actually a slide set that I've put together a few years back when I was the CEO of Al Ghurair Investments. And this is because we were looking at a number of investments or acquisition in small, medium-sized enterprises. So I took these slides, adapted them, and will be sharing those with you. So these applies as much as for startups as they do for small and medium-sized enterprises. And it's a process that you need to get familiar with because you need to understand the perspective that is coming from the people sitting across the table, so the investors. So we'll go through with the process, we'll go through with the frameworks. Let me put I'm going to put the screen on so that you could see at least my face for a few minutes. So where is this? Okay, it is. All right, so video. Good. So you can. Good morning, everyone. Okay. Okay, so let me go back to the setup. Resume share. Okay, and then go back. This one smaller, and this one bigger, and this one. Okay. So what we're going to have is we're going to have not only the frameworks and the process, but we're also going to have a number of participants. So I've asked both on the investment side, but also on the investee side. So we're going to, and I'm asking them to come up with they'll present briefly their company. They will also present the key learnings that they have in taking organization or having gone themselves through either due diligence or term sheet. We have, so these companies, you know of a couple. On the investment side, I'm asking Samar from Berytech. I've been working with Samar for the past 5 years. She is the pillar in terms of investment management for Berytech Fund 2. She has been evaluating and negotiating term sheets with more than 25 different companies. And she has a breadth of experience from the investment side. So Samar will be joining us later. I've asked on the investment side, I've also asked Flat 6 Lab. Flat 6 Lab is an accelerator, but they're also a VC to provide their perspective in terms of what they do. So you have an opportunity to listen from the investor side. I've asked also IDAL. IDAL is the government entity that now is launching a platform that is allowing companies that are looking for funds to be matched by investors who are looking to invest in different companies. The platform is not yet launched, so IDAL would be, and IDAL provides due diligence. So what they do is they screen the companies before these companies are put on the platform, the same way they screen also the investors before the investors are matched with the companies. So it's important that you listen from their perspective. I've asked my friend Ziad. Ziad is one of the companies that have been funded, it's cardio diagnostics by Berytech Fund 2, actually started by Berytech Fund 1, not Berytech Fund 2, my apologies behind it. And he went through 2 rounds of funding, so to provide his perspective on the learnings from the due diligence and the term sheet. I've also asked Marc, who has been going through also 2 rounds of equity funding and went through 1 round of debt funding as the head of Atelier Jumiel. And one of the companies that I sit on the board, as some of you know, I've been also active in both East and West Africa. One of the companies is a hospital. In these days, it's one of the leading hospitals in Ghana. It's the Niaho Medical Center. I've been working with them for the past 4 years. I've asked the CFO to come in and to provide the perspective. Now, why it's important? Because he went through several rounds of debt funding, and the last one is with IFC. IFC is probably the most recognized, established organization that invests into companies, private companies across emerging economies. So they're very active in Lebanon, but very active in Africa, very active in Southeast Asia. So you're going to get perspective from different, and each one is going to add some new dimensions and some learnings on it. So we're going to keep them short. They have about 5 to 7 minutes to present briefly the company and briefly the learning, and then you have about 5 minutes for each one of them to be able to ask questions. So what are the questions that we're going to cover? The first one is what are the phases of investment readiness, including due diligence and term sheets. So just a refresher. I'm going to structure it in the way that you know, but I'm also going to structure it in the way that VCs use, so you could see it from their eyes. We're going to also go through why do we need due diligence and term sheet? Why don't we decide to go and invest immediately? And so why do we have to go through a process, especially as these processes are very time-consuming process? We will then focus on the term sheets. What does it look like? What are the different clauses? Why should you know each of these clauses and what each clause could mean to you in terms, and to the investors in terms of either financial control or the loss of control that you might face. So we will go through. I sent you all an example of a term sheet. This is what I call a bad term sheet. I mean, there is no good or bad, but this is a term sheet that is clearly in favor of the VC. When you read it, you might not realize it immediately, but the devil is in the detail. And it's very important for you to understand where can the detail be, and make sure that you understand what it is. I mentioned that we're going to get the perspective from business angels, from Berytech, Flat Six Labs, and others. And then we'll wrap up with the key learning. Each one will come up with a key learning, and I've summarized it. So this is now, we might not cover it all in 3 hours. If we don't, we will restructure another one for an hour or an hour and a half, depending on how long it takes. It's a very important topic because this is, if you want, the topic that seal the interest of investors in investing in a company. So the due diligence is a fundamental process that goes through it in order to validate whatever the investor have heard. And the term sheet is a way to reflect the output from the due diligence into what are the key terms that we would like to go and work on in case we go and we decide to invest. But normally when you're at term sheet level, the decision to invest is very high. It's only a question of negotiation on a few topics that we will go through it. Now, this is a list of questions. You have it in front of you. I'll stop here and I will take other questions that you would like to bring up. So if there are other questions that you feel are important and then we should include, please unmute and share your questions, and I'll do my best to try to answer them. So any other questions beside the one I'm trying to address? Okay, let me look at chat. So for the moment, good morning to all. My Pro is not working for some reason. Okay. Yes, okay, very good. So no question. Excellent. So let's continue on this basis. Okay, so what are the here? I pushed something I shouldn't be pushing. Okay. What was this? Okay. Yes. Okay, the introduction. So what are we it's the same format that I use, but here I changed the wording. So here it's about enabling entrepreneurs, MSMEs. For those who are new, it's micro, small, and medium-sized enterprises. These in Lebanon account for about 97%. But if you look across emerging economies, 95% of all registered companies are micro, small, and medium-sized. So small is below 50, between 10 to 50. Medium is between 50 people to 100 people. It differs across countries, but on average, it's all companies that have below 100 people in terms of their and their boards, in order to help themselves be prepared. In this case, we're going to focus on the due diligence and the term sheet. The way we do it is like in all workshops. I'll provide the frameworks. I'll explain the frameworks. Then we will listen for how these frameworks have been implemented across different companies and different investors. And these are the best practices or the worst practices that we have. And then in case you are interested, some of you are in the process of raising debt and equity, and you want to sit down on a one-to-one basis, Berytech, we offer this service, and this is part of what we do. I have a list already of about 8 of you following the valuation, company valuation, who ask, and I'm going to get back to you. This week has been a big tactic. Next week, and set up the one-on-one meetings, and we could do this also for this. So in case you want to reach out, you have my contact details, and happy to schedule time with you on a one-to-one basis. Okay, let me start with a quote. I love these quotes. I love this smiling face with his pendulum. So there are 2 different key dimensions that matters in due diligence and term sheet negotiation. One dimension is the economics dimension. Basically, is the investor is looking at protecting his financial return. And you will see a number of clauses are going to be related to the financial return. And I will share with you in more details what are the clauses. But on the other side is control. So if you want, we want to provide the right returns to the investor, but at the same time, the owner wants to maintain a certain level of control in his business and doesn't want to be micromanaged on each key decision that they have. And this balancing act is what defines, if you want, the the dynamics of the due diligence and term sheet negotiation process. Okay, this slide you've seen, a number of you have seen it. I'm sharing it here because these are, for those of you who are new, this is the 12 phases that we have in getting investment ready. And you will see that there is some overlap, and it's on purpose. The first overlap is between phase 1, which is the gap analysis, and you're all familiar with it, is where do you stand today as an organization? What are the core competencies that you have? And what are the development areas that you have? And you better know it before you get into a term sheet negotiations. You need to know what are the gaps that you have, what are your core competencies, because you're going to leverage on these core competencies, and you're going to have a very clear plan on your gaps that you face. Because if you don't do this, you will have a tough time in the negotiation process. Now, this is the first, and this is done pretty quickly. We typically sit down with the leader, we sit down with the team, and in a matter of about 2 to 3 hours, and we could do this virtually, we will do a gap analysis and come up with the key areas to focus on and the key core competencies. Now, the overlap, it goes with the phase number 9, which is the due diligence phase. The due diligence phase takes, if you want, the gap analysis, but goes in much more detail. Yesterday, as some of you know, I'm part of CEDAR. CEDAR is the Business Angel Fund. We went through, over the past, actually few weeks, 6 weeks, I don't know if Hassan is on the call, but we went through a due diligence. I was part of the due diligence for a team for 2 companies. One was Sea Green, and the other one is Clean2O. Now, Clean2O and Sea Green went through a series of meetings that we had, and going into a lot of details, not only on their business model, on the customer feedback that they have received, on the size of the markets, on the financial projections. So we, and Hassan, who was leading the one for Clean2O, because I was there, I'm still their coach, I couldn't be, I was conflicting. I mean, Hassan spent a good, I would say, at least 5 or 6 full days with the Clean2O team in order to be able to get answers to all the questions that he has. And after this, what he did is that he completed a presentation, and he presented this yesterday. So this is, and it was extremely well done, very structured. We have a format that I will share with you. And based on this, the investment committee, in this case, it's the CEDAR's members, so all the business angels, we will vote. We will vote over the next few days. And my sense is, given the quality of the write-up that he has done, the quality of the answer that we have received from Clean2O, there is a very high likelihood that we will fund Clean2O and be able to get also matching from another VCs, Flat 6 Lab, who have already funded Clean2O. So the due diligence takes the gap analysis, but goes into much more detail. So, and this process could last a month, could last 2 months, could last even 3 months. So this is where everything about the organization will be known, from the relationship with their customers, to the relationship with their suppliers, to the relationship that they have with their investors, if they have already investors on board. And it's getting so confidential that you are bound to sign what we call a non-disclosure agreement in order to protect the confidentiality of the information that will be shared between the company and between the potential investor. So this is the first overlap. But there is a third or second overlap. The third one is phase 12. On phase 12, you also go, but you focus on the areas of concern in the due diligence that you feel have the highest probability of happening and the highest impact. And for those, you work with the team in order to develop a very consistent mitigation plan and mitigation actions. So if you want, in this process, the notion of due diligence is embedded into the gap analysis, it's embedded into the formal due diligence, and it's embedded into your key risk areas, or what I call the risk management framework. So these are the 3 parts when we go through this process phase. And the term sheet development and negotiation is phase 10. And it's sitting after the due diligence. Why? Because the due diligence is going to highlight skeleton. And all of us have skeleton. All companies have skeleton. And if your due diligence is done in a right way, the due diligence will come up with these skeletons, put the skeletons in the face of the investor, and then will tell, because of these skeletons, look at phase 7, your valuation that we have agreed is actually not applicable anymore. It's going to be lower, because of these risk areas that you face. So this is why it's extremely important to have the due diligence before the term sheet so that you could validate it and you could make sure that the valuation that you include in the term sheet is as good a reflection of the value of the company that they have. Okay, so this is as a nutshell. I don't want to spend too much time on this one. You've seen it. I go through it for those who are joining us for the first time. When you do the gap analysis, I called it the 12 M's. For those who don't have it, you could Google my name and you will get this article. It's been published a few months back. It goes into the detail of each one. So these are the dimensions where you could do, where your company and you as a leader have done a great job, or have done a medium job, or have done a lousy job. So these 12 M's are all important. Now there's going to be particular attention to point number 2. We will spend a lot of time as investors to talk to the team, to talk to the advisors, to talk to the board, to ensure that we have a complete and competent team. There's going to be a lot of attention, of course, on the scalability of your model. Is this something, this is point number 4, not only is it a big market or attractive market, but do we have scalability potential? This is important because we always want as investors to invest in companies that have scalability. The point number 5 is also important. Why you? What are you unique at, and how can you maintain this uniqueness in 3, 5, 10 years down the road? And the others are fairly comprehensive that we have covered. The risk mitigation plan is something that we'll cover as part of the due diligence. So now, why is a disciplined investment process important? I'll go through the 5 phases of an investment. This is now coming from the perspective of the investor. And I will discuss these 5 phases and focus on the ones that are more important to us. Now, I'll start with the quote. Why is a disciplined investment process? Because if you don't discipline yourself, the world will do it for you. And it's very true. As some of you know, I've been the CEO, group CEO for Al Ghurair. When I first started, I did the gap analysis. You will, let me go back to this. I did the gap analysis and I came up with a list of the investments that the group has made over the past 10 years. I listed all these investments and I listed the expected return when they approved the investment. And I've listed the actual return 5 or 10 years later that these investments have done. Now this was in some ways, I created a burning platform because I showed them, and most of these investments, I will focus on the top 10 investments. And you had an oil refinery in Pakistan, you had another oil refinery in Libya, you have a cement factory in Syria, you had a number of different investments in across the MENA region on it. And there was a huge gap between the expected return and between the actual return. And there was, for a number of them, severe value destruction that took place. Now, by doing this, what did I first created a burning platform. I hold the board responsible because the board was the one who approved these. And I showed them that the investment management process was not working. And it was done in a half-baked way. And this is, if you want, the most effective one to come up and to validate this. So following the, I came up and worked with my team, and we came up with a process. We say, look, in order to avoid the wrong investments that we have done, and this applies for this group that acts as an investment group, but applies to all the VCs that we have in Lebanon and in the region, all the private equity companies, and every single person that is making investments, the recommendation is to go through this phase. Now you could simplify the way you see, the timing that I've put could be plus or minus, it doesn't matter. It depends on the size, it depends on the complexity, but it's an important slide. And so you have these 5 phases. The first phase is the screening phase. This is a few days. In a few days, you go, you screen, and I'll show you what is the form that we use in order to be able to screen. And this you decide whether yes or no, it's an investment worth following. The squares in the red, you normally would always go back either to an executive committee or an investment committee, or it's a board, depending on the size of the company, to validate. So normally when you come up with your screening scorecard, you will then show it and you would look whether this makes sense, what are these investment opportunities, what sort of fit it has with our company, and then the investment committee will say, go ahead. So once you go to phase number 2, which is the evaluation phase, here we go in much more detail. We have 2 to 4 weeks instead of 1 week, less than 1 week, and we develop a proper investment thesis. So this is like an investment memorandum where we go into much more detail, but we look at it from the investor perspective. Does this make sense for us? We also do the valuation. You remember we had the company valuation workshop last week. This is where we perform the valuation behind it. And then we present with our recommendation. Again, we go back to the investment committee. This is the second phase, the evaluation phase. The third phase, the investment committee will say go or no go on the basis of the more detailed investment thesis and on the base on what the valuation range is going to be. Now, at this point, if the board says yes, then we start the negotiation in terms of the term sheet. So you could call it term sheet, others would call it memorandum of understanding. Term sheet is the most widely because it's very specific. And memorandum of understanding could be very generic. A term sheet, every one of the bullet points are very specific. So where the MOU is typically signed when a company wants to make an announcement. We sign an MOU with such a company. So we have interest in pursuing some partnership, whatever. The term sheet is extremely specific in terms of the term that you want to invest, how much you want to invest, what is the valuation, what are the controls, conditions, etc. So this is all done, and this is why it takes 8 to 12 weeks. So it's a process that could be 3 months, it could be more, depending on the size of the deal. Once you do the term sheet, you go back. When the term sheet approved, you go back to the investment committee and you validate. Is this make sense? So if they say it makes sense, then we go back, we do the complete due diligence, finalize it. If we have to adapt the valuation based on the finding of the term sheet, we will do it over here. And we look at the key risk assessments that we have. And then we go back to submit it and get the final approval for what we call the closing the transaction, which is the shareholder agreement. Shareholder agreement is built on what the term sheet has done, but it goes into very much of the legal terms. So you look at the capital structure of the company, you look at a number of other elements behind it, but this is the legally binding document, the shareholder agreement that you have on both sides, of course. Now, I mentioned the due diligence phase here. So the due diligence you've done, we go into the details of it. Now, people could do it before, or they could do it after the term sheet, but whatever the due diligence is going to be a key for, and if it's done before the term sheet, then there is a review of the valuation, which was conducted earlier based on the finding. But due diligence is critical because it would validate the key assumptions that the company has presented. Now, what are the deliverables? If you look at the deliverables, which is on the bottom, for the screening, it's the what we call the investment thesis. This is a one-pager, and I'll show you how it looks like, and I'll show you what are the questions they will be raising. When we get to the evaluation, this is where you have to start with the NDA. An NDA is a non-disclosure agreement. You sign it because we're going to ask a lot of detailed questions. And there's going to be also an investment thesis. This is what we do with a number of the companies. Sabah is on the call. A number of the companies that went through Agritech, are going through other of the accelerators, went through an investments memorandum that they've put together, and they also went through a valuation model. These are the output, these are templates, these are framework that we use, and we score the investment scorecard. Then we move in terms of the third phase. This is the term sheet. I sent you an example of the term sheet. It could be an MOU. I'm going to focus today on the term sheet. On the due diligence phase, you have a due diligence report. I will share with you a typical due diligence report. A number of companies are asking Berytech to come and please do a due diligence on our company, either in terms of our financial controls or in terms of our expansion strategy. And we do this. This is one of the services that we offer. And this is, it could be about 2 weeks, it could be 4 weeks in this case, but we do these due diligence reports for companies that have either an interest to expand and to get equity funding or debt funding, or because they want to identify the gaps in their organization. So this expertise is available, and this is, and I'll share with you a typical document. And the last one is here, what we call the shareholder agreement. So these are, if you want, the deliverables for each one of the phases. Let me stop before we go into the detail and to see whether there is any questions at this point in time. Any questions from the team on what I've presented into these files? This is an important slide. It's an important slide. You could adapt it to your organization. You could shorten it if you want, but this covers all the key elements that we will have. And the bulk of it is going to be on the due diligence side and on the term sheet side. the bulk in terms of the preparation and the work and the negotiation on this. Any questions? You could put it in the chat in case you have a question and you're too shy to. So if there's no question,
this is a super slide because you have the phases and everything is numbered. You're super organized. This is really good.
Thank you, Tanya. Thank you, Tanya. So this is what we now. You could simplify it, but trust me, a bulk of what is going to be covered is things that you need to be aware of if you have, being it on the investment or the investee side. Okay, let me start with the first one, which is the screening phase. I'll go quickly because I really want to focus on due diligence and term sheets. So phase 3 and phase 4. So I'll go quickly through phase 1 and phase 2. But what is phase 1? Phase 1 is what Joël gets. Joël is the one coordinating this event. She gets a couple of companies who come. Look, we have an investor that is interested, or we are interested in joining your accelerator program, and we want to find out whether the company has what it takes to be a member of the acceleration fund program and get the funding required. So what are the questions typically we're going to ask? One, is this investment attractive enough to invest the time and the cost to conduct a detailed valuation and due diligence? So this is the question that is the key question to ask. And how do we answer it? We look at 3 dimensions, and you're going to hear these dimensions again and again. The first one, strategic. Do they fit? So if, for instance, our accelerator is on social enterprise, would the company fit in terms of the criteria for social enterprise? Do they have a social impact? Do they have a track record in terms of social impact? Have the founders or the involved in social enterprises in the past? This will be the strategic dimension. The financial dimension, can we make money? If we invest in this company, can we make money? And our expected returns are going to be aligned or greater than our required rate of return. So every investor, being it yourself, even when you buy a piece of land or you buy an apartment, you have in your mind an expected return. When a bank is lending you, their expected return is the interest rate that they charge you, plus whatever premium they charge you upfront or annually. An equity investor, you could ask the question, everyone, being it Berytech, being it Flat 6 Lab, being it IM Capital, all of them have a certain expected return that could be as low as maybe 10 or 15% and as high as 30 to 35%. So it will be in this range, depending on the investment strategy that the board would have on this one. So the second dimension is financial dimension. And now for an accelerator, we want to take companies that have the ability to scale. Can they really grow? Do they understand their business? So this is the second. And the third one is operational. Do we have the capabilities to execute this investment? So do we have the right support? Do we have the right skill set? Do we have enough money? Do we have the technology to be able to help this company scale? This is very important. So strategic dimension, financial dimension, operational dimension. So these are the ones. How does it translate to? This is what it looks like. The investment teaser, I'll share with you the slides on it. So it's a 2-pager. It's very simple. It's look at the, first is the overview on the investment opportunity. So what is the overview? How much are we going to invest? Then there is a brief company history. What are the key facts, manufacturing, what do they do? What is the company key features that you want? The third is that in case we invest, what is going to be the business strategy moving forward? Any new products or services, any new geographies, what are going to be the pillars of growth? What are going to be the pillars of scalability for the company? And the last one is on the key indicators of financial performance. So we put a few figures, if case they're shared. Remember, at this stage, this is the preliminary stage. We still might not have access to the data. So it depends on the investor's ability and willingness to share the data with us, so we will share this data. This is the 2-pager. And this 2-pager will then have a recommendation in terms of, so this is what it looks like. I call it the investment screening document. So remember the 3 pillars: strategic alignment. Does it make sense strategically? Financial alignment. Does it make sense financially? Can we make money out of it? The third dimension is operational feasibility. So these will be, and these are the questions. You could add your questions. You could modify these questions behind it. So on the strategic alignment, is it an attractive market? You know, growth-wise, what is the dynamics? What are the trends? is the investment opportunity aligned with the key success factor in this market? To succeed, these are the 2 or 3 things that we need. Would the company have it? Looking at competitive advantage is very important. Do they have an advantage versus the others that they funding with? AGI is Al investment. So this is, I didn't change the slide, so I kept it the way it is on it. So we have portfolio synergies. If we invest in this company, would they have synergies with other companies that in our existing portfolio that could benefit from it? So this is on the strategic alignment. On the financial, how much money do they require? Do we have this money? What will be the type of returns we will get? You know, so, and this is the first pass. This is not detail. This is first pass in terms of the questions. What are the risk areas that they face? We look then at the feasibility. Do we have the right management? Can they execute? Can we work with them? How scalable is the infrastructure? If we want to move from one country to the other country, and how can we deploy this model cross-country or cross-region? So this is one form. Take it, change it. And then what we do is we do a rating. And the rating is green. We believe they have a good track record. It could be yellow, where we believe it's so-so, or it could be red. We believe it's a red area. So we do it by each of these. So the green color behind the cross is we feel that this is a strength. The red color is we feel that this might be a big weakness. And then we come up with recommendations. We decide to go, but this is recommendation for what? For going to valuation, so going to more detail. So this is important, familiarize, you get, of course, copy of all the slides. You need to fill in the evaluation form. So Sheila will send you the evaluation form. In the evaluation form, for those who fill, you will all get the copy of the slides. Now there is a phase that I missed, is as we go through these 5 phases, what's important for you to realize is the volume of the information is going to grow, is going to get increasing. As we move from one phase to the other, we build up information, market study, customer feedback, financial evaluation. We have the technology, we will validate the technology. So you're going to get a lot, and we call it the data room. So if you want, your data room could be virtual, of course, is all the information that you need in order to build up the case for or against this investment. So as we move from one phase to the other, the level of information or the granularity of this information, i.e. becomes very specific, increases. On the opposite, the size of the audience, when you start, it's very broad. So when a company is looking at raising money, they will talk to several investors. They might talk to about 10 different investors or even more. But as we move along in terms of the different phases, the number of those will reduce. And at the end, for the last 2 phases, there will be only one bidder. And it's only in case the shareholder doesn't work out in terms of shareholder agreement that we'll find another. So bear in mind, data will increase, volume of data will increase, granularity will increase, but the size of the audience will decrease with time. Okay, so this is important that you know. Next. Okay. So let me take the question. There are any questions. Chat. Hello, sir. Something came up. Okay, no problem. So this is good. All right. So we have. So let's continue. Okay. The second phase is the valuation phase. On the evaluation phase, we're going to get, we go into more detail. So we take each of the 3 in terms of the strategic rationale, the operational rationale, the financial rationale, and we add to it the risk assessment. The risk assessment are what are the key risks that we face, what are the mitigation plans that we have in place, or they need to have in place if they don't have it, and the strategic rationale, what are the objectives that we want to achieve with this merger or with this acquisition, does it make sense for us strategically, the operational rationale, what are the synergies that are critical for our business, and the financial rationale, what is the valuation range, which methodologies are we using. Okay, so this is the second phase in terms of valuation. The investment thesis go into more detail. So we look at the market, we look at the assessment of the market, we look at trends, we look at the competitive landscape, we look at the unique selling proposition, We look at some of the benchmark ratios, you know, looking at valuation versus revenue, and we have a number of these benchmarks. We then focus on the strategic and operational rationale. What are the why? Why are we investing? What is the investment rationale? What are the synergies that we could generate? And what are the operational capabilities that are needed to execute on it? On the valuation, we build the valuation model. We do some scenario planning. You know from the valuation workshop that we have different valuation methodologies. And then on the risk, we identify the risk. We quantify the value of these risks. Why is it important to quantify them? Because I would use them to be able to change the valuation. So if I believe that the risk has an impact potentially of, let's say, I don't know, $200,000 on the profitability of the company, and we have a multiple of 8 times profit, then this $200,000 is about $1.6 million. This could affect what the value range is or the revised value range is. And this is only done when you do the risk assessment. So how does it look like? Now the valuation, we conducted it. Joel, myself, we went through it. This is a very simple way to do it. You have different ways to value. You could value by looking at the present, or you could value by looking at the future. Looking at the present means where are we today as a company? So the net asset value is the one, is we take your balance sheet, we look at your assets, we look at your liabilities, we update the assets to reflect whatever premium you will get because of, I don't know, a specific work that you have done or patents that you have or certification that you have received. And then we subtract from it and we come up to the net asset value. This is the lowest value. The problem when I put the red mark on it is you're not including the future. And the future could be very important, especially for startups. The other way, what you look at in terms of the present, you look at your present turnover and we come up with a multiple. We know, for instance, that for these sort of companies that in this marketplace, typically when you have not proven scalability, it's 2 times your revenue. When you have proven that you could scale, it's 5, 6, 7 times your revenue, and we go onward. This is the performance multiple, and we use it also. When you move to the future, it's a discount cash flow. Now, the problem with the other axis, independent versus comparative. Independent means we look at your company alone, standalone. Comparative is when you look at your company, but we compare it to other companies that we either have financed or we have data on it because they're either public or because we were able to access information. For each one of those, you're going to have challenges. So on the discount cash flow, your forecast accuracy is, we don't know to which extent are you going to make those numbers. And it's very assumption driven. On the growth multiple, it's the when you compare, are you really comparing apples to apples, this company, because there is always difference from one company to the other. So this is the summary of the different valuation. This is how the investment scorecard would look like. You're going to have the details in the annex. This is a 3-page document. We go into each of these categories, and for each of the categories, we go into much more detail. And we come up with a ranking, green, yellow, red on it. We come up with the valuation, we do the financial forecast, we come up with the risk assumptions that we have, and we come up with the valuation range. So this is what your investment scorecard is. You take this investment scorecard and you go back to your investment committee and you say, should we go and work on the term sheet? And this is where you get the go, no go. This is the pre-negotiation. This is where we start talking about term sheets, and this is all MOUs that you have. Okay, so I've run a bit quickly. Let me check the time. 9:45, very good. So this is the third phase. So the third phase here, we negotiate the terms and conditions, and we reflect those in the term sheets that we have. So this is really the pillar on term sheet, and this is the largest pillar in terms of time. So it takes 8 to 12 weeks in this process, and it might be, as I said, more on, so we will, so this is the pre-negotiation phase. So let me go. What are the documents? I shared some of the documents in the screening and evaluation, depending on the company, typically, definitely in the evaluation, but in some cases, even in the screening, they might want you to sign a non-disclosure agreement, or you might want them, so if it's the company, to sign an NDA. And we'll give you copies of the NDAs in case you don't have one, but this is, you could get it from the internet. They're all fairly standard in terms of the terms of the, so this is non-disclosure agreement that protects you so that the information that you are sharing with the investor is not going to impact your business. You want to make sure, especially if we're talking about patentable material, if you have IP, if you have others, you want to make sure that those are are protected, and the NDA is here to protect you. So this is, when you get into the pre-negotiation, you have the MOU and you have the term sheet. We will focus on the term sheet here because it's the most relevant one. And then when we do the closing and integration, this is what we define as the sale and purchase agreement, which is basically your shareholder agreement. So these are the legal documents. So normally your lawyer should have the NDA. All of you should have a copy of an NDA that you use. If you don't, reach out. In the term sheet, I sent you an example of a term sheet. Don't matter the content, but what matters is the structure. And the structure will be very similar from one term sheet to the other. Some could be very simple if you're doing a debt term sheet. Others will be more complicated if you're doing a convertible debt, and even more complicated if you're doing an equity term sheet. So these are, and the last one is the purchase, the shareholder agreement. This is very much a lawyer sitting down and taking the term sheet elements and including all the legal jargon that needs to be added so as to protect the interests of the shareholders. So these are the legal documents that you have. The NDA, so briefly, what is the NDA for those of you who have not seen an NDA? Is signed usually at a very early stage before preparation. So what you do in the NDA is you define what is confidential. You define the disclosure period, because you don't want to have an NDA which is indefinite. And typically somebody is an investor, is interested in investing in your company. You're going to give him or her an NDA, but for a period, maybe 1 month, 2 months, maximum 3 months. You don't want to do more because you don't want to have, especially if there is exclusivity, you don't want to delay the process, as you are keen to talk to as many investors as possible. So the disclosure period is mentioned. The exclusion from what is confidential. So there might be things that are not confidential and can be shared. So you specify those, and then you have the terms. The agreement is binding. What do you mean by the terms? The disclosure period is a period by how long can you keep so the NDA is valid, but at one point in time you don't have anymore the right to access information. The term in years of the agreement is binding, is how long you need to keep this information and not share it with anybody, so not to jeopardize the company. So this is all included, and be happy to provide you a copy of the NDA. The MOU is similar to the term sheet, but it's very generic. So an MOU says, you know, we have an agreement, this is our purpose, this is how we're going to work, this is your responsibility, these are my responsibilities. We might have some warranties, insurance, we might have some termination clause behind it, and then we might have some exit options, and then we have the governing law. So this is the MOU. I'm going to focus now on the term sheet. So let me check to see if there is a question. This is, we're getting now to the core of our, so scorecard is after. Okay, so the scorecard, this is the question that have been asked, Raja, hi Raja. So the scorecard, what you do when you have your teaser, the teaser is when you put together your 1-pager or 2-pager. Now, when you are presenting the teaser, you are not only presenting the teaser with the key elements, but you're also presenting recommendation. And this recommendation is going to be based on how you are ranking the different elements of the teaser. So if you feel, for instance, that they have a wonderful team, it's a 10 out of 10. It's a definite green. If you feel that their scalability is not proven, this might be a yellow. If you feel that their financials are completely unrealistic, this could be a red. So when you do your teaser with them, because you're actually either they have a teaser or you help develop a teaser, you then rank the teaser. When Joel, Mario, myself, we sit down with the agri-tech companies, they all have a teaser. But then we sit down and we do a ranking. So we tell them, look, this is not good. This is still, and we come up with an overall ranking. And we say, look, if you want to move from phase 2 to phase 3, you better get your act together on these points. So in some ways, we are doing an evaluation, and we're telling them, today you're not passing the. So you better get your act together over the next 1 month or 2 months before we invest. So the ranking takes place, yes, Raja, after the teaser. Now we get to the term sheet. Now the term sheet, what is it? It's a written document that includes, let me put my, that includes the important terms and conditions of a debt. It could be convertible debt, or it could be an equity, and I'll go through the detail of it. It's a non-binding agreement. It's important to mention. Non-binding means that you are not, it's not legally binding. This is The legally binding document is the shareholder document. This is a legally binding document. Now, the only thing that is legally binding in a term sheet is the how long do you have to conduct your, this term sheet has a validation, and this is binding. And normally you will not have more than 2, as I said, 3 months, so that because you want to know whether we're going or we're not going. And I don't want to wait 6 months, because if I'm negotiating with you, I cannot negotiate with another. So the exclusivity period is going to be binding. And if I give you a month to do your due diligence and to come up with the term sheet, or 2 months, I'm not going to wait for 6 months or 9 months, because I'm going to be losing on other opportunities. So this is the only part that is binding. Now, here you have in a term sheet, you have 2 pillars. And I know for some of you, it's going to be the first time that you go through it, but it doesn't matter. We are here to help you. Afterwards, when you have a real term sheet that you need to do, we will sit down with you and explain. So here it's more of a first approach to. One side is the economics or financial returns. So you have clauses that are related to the economics, and you have clauses that are related to the control. And your role is to be able to find the right balance. So what do you have as terms or clauses in economics? Typically valuation. The valuation will be definitely mentioned in the term sheet. So you need to make sure that you understand valuation. Anti-dilution. There will be anti-dilution clauses on behalf of the investors to protect in some ways his investments. And most term sheets will have them. Preferred stock or preferred shares. I will explain to you. ESOP is the Employee Stock Option Program. Now in Lebanon, it's still not yet, but this will have an impact, because if you have ESOP, it dilutes the founders, because the investors might push an ESOP, and this ESOP comes from the shares of the founder. So this is important for you to know. Liquidation preference, I'll go through it. Exit provision, very important. And you will see in the term sheet that I sent you, the exit provisions is what kills the deal. It kills it completely. So you need to make sure that you understand what these exit provisions are before you get into it. On the control side, we have drag along, tag along, we have key staff appointments, we have appointment to the board of directors, we have reserve matters. This is very, very important. Reserve matters are all the points where the investors is not letting you take the decisions without him or her being involved in the decision-making process. So basically, I have a veto right as an investor, and these reserve matters could be a very long list. And vesting. So vesting, we will go through these. So these are the terms. We go through these terms in terms of term sheets. So let's start. I always have a problem. Okay, here it is. Okay, so what is the term sheet? So the term sheet, as I said, is an initial document providing a roadmap to the definite agreements. What are the definite agreements? It's a shareholder agreement that will control the key points of the investment deal. This is bullet points. So you have one bullet point after the other, and you might have 3 pages or 5 pages or 10 pages of bullet points. What are these different structure? The investment opportunity, the type of investment being purchased. So what are you looking at? It could be debt, it could be convertible debt, it could be equity, and what are the assets? Why are you using this money? What are the reasons for it? It would mention what we call the pre-money and the post-money value of the company. So you refresh your mind on this for those who have not gone through the valuation workshop. It will discuss about the value of the assets, the liabilities. It will mention all the different elements of risks. It will refer to the, I'm sorry, I'm taking a glass of water. Okay, so what are the types of term sheets? You will have simplified 4 types. You have the grant term sheet. As you know, Berytech has won an important program. This is a program where we're going to be working with 50 social enterprises across the region. And this is, we're going to provide these enterprises with grants, but we're also going to provide them with coaching and technical support. Now, this is a fairly large program, but the grants that we're providing are grants with milestones. So we tell you, we give you the money, but we give you the money on these conditions. So if you want, there will be a term sheet, even though it's a grant. It's free money. We're not taking any debt position. We're not taking any equity position, but we will have a term sheet when the donor is investing money in the company against specific milestones or metrics. So this is an investment in terms of a grant, but it does have a term sheet. And we will do one with each one of the companies, although it's purely a grant. The second one are the debt capital or the debt term sheet, these are tend to be simple. This is when you make a loan. This is the term of the loan. This is the size of the loan. This is the interest rate. This is the grace period in case I give you a grace period. This is the payment schedule. This is the documents that I need from you on a quarterly basis. This is the penalties in case of detail. This is a debt term sheet. So it's fairly, the convertible debt term sheet is a bit more sophisticated because here not only you're providing a debt, but we have in here the option of the investor to convert the debt into equity. So this is an option. So you have, so what we need in the convertible debt, we start talking valuation. If I convert it at which valuation? So this is an important element behind. So the that you have. So what is the terms of the convertibility? What are the timing of the convertibility that you have? What is the size of the convertibility? This is important, and this will be mentioned in the term sheet. The last one is the equity capital term sheet, and we'll be focusing on this one too. Now, the one I sent you combines debt, convertible debt, and equity. So you have it all in it. So the equity is when the investor is investing money in the company for a fixed percentage of the shares that they have. Okay, so these are the different term sheets. I'm not going to go to the economics now. I want to check whether Ziad is on board. So we're going to have our first company coming in. Ziad, if you're on board, please unmute just to make sure. Participant, if it's not, I'm going to continue. I'll check the participants. A number of very familiar faces. Good morning to all of you. So our friend Ziad is not Ziad. You have a Ziad, but it's not the Ziad I want. So that's good. So let me continue on this basis, and then when Ziad will come, I'll stop. Okay. So what are the clauses that are related to economics? Economics means the financial returns expected from the shareholders. Valuation, liquidation preference, anti-dilution, ESOP, exit provision, preferred shares. So there are others, but I'm now going to focus on those. You might not get it the first time. It doesn't matter. It doesn't matter. You might find it, again, it's Chinese for you. It's okay, because we don't expect you to be expert in it. We're here to be able to help you and support you go through this. Okay, so let me start now with the valuation one. So the valuation is that first you need to understand that there are two concepts. One is pre-money and the other one is post-money. Now I know I covered it in the previous workshop, but pre-money is the value of the company before the investment is made, and post-money is the value of the after the investment is made. In the case of, take the case of Clean 2.0. Actually, I'll show you an example here. So we have, let's say we have gone Clean 2.0. Clean 2.0 went through, I've changed, of course, the numbers. They had a first level of funding with flat 6 slab. Their first level of funding came up with a pre-money valuation of about $1 million. Flat 6 slab invested about $150,000. Their post-money valuation was $1.15 million. Now they're coming to Cedar and they say, look, this is our post-money valuation 6 months ago. We believe today, I'm inventing a number, our valuation pre-money before we get into the Cedar round is 1.5 million because we have increased value over the past 7 to 8 months. So when they approach us, and let's say we agree as Cedar, we will say, okay, 1.5 million, we agree. And Cedar, let's say, would invest about 200,000 on it. We go, so the pre-money is 1.5 today. The post-money will be the 1.5 plus the 200 will be the 1.7 million. So it's important that you understand the two concepts. It's fairly straightforward. So pre-money is before you receive the fund. This is equity fund, not debt fund. This is equity fund that you receive. Post-money is after you received it. So let's say that you have two founders initially. We had the valuation was 800K. We have Sami and Leah at 50-50. And then we came up and we invested 200K. You will say if the value pre-money was 200 with 800K, with 200K, most people would say, okay, you're getting a quarter of the company. It's wrong. You putting your 200K, the value of the company moves from 800K to 1 million. So your 200K becomes 20%. So what happens, this is what we call the capitalization table. It's a, excuse me. So the capital table initially before the investment, Sami and Leah had 50-50. After we came in with our 200K, we took 20% share. They were diluted by 20%. So diluted by 20% on 50%, this becomes 40%. Leah becomes 40%. We as a VC fund are 20%, and this is the dilution. Now, why is dilution important? Because Sami and Leah might go through 3, 4, or 5 different rounds, and every time that they go through a round, there is going to be dilution. Every time, unless there is at the same valuation. We could have said to Clean 2.0, you know, we believe the past 6 months have been difficult times for all of you. We don't think you've done a lot. We're going to take our pre-money today as what was the post-money 7 months ago. So if it's 1.15, we might take it at 1.15. And here there is no change. There is no increase in terms of the valuation on it. But we are good people, and we normally invest in companies that increase in value. So dilution is important because you might be diluted every time we go through a round. Now, how many rounds would you get? So I've used the shares.
Constantin, I have a question.
Yes, go
sorry
ahead.
to interrupt. When the investor that's coming in has an added value in terms of being able to add value beyond the amount that they are investing, is that counted in the valuation of his injection, or
Okay.
you see what I mean? So
Yeah, completely. Look, this is a very good question. What Tanya is asking, I'm going to give specific example. Clean 2.0 is coming, and they say our valuation today, let's just say pre-money is 1.5. And within Cedar, we have the managing director of a water bottling plant. What Clean 2.0 do, they do filters for clean water. So you put these filters, it cleans, it removes everything, bacteria, metals, everything in your water, and it becomes drinkable water. And Lebanon is a big issue on it. And they say, look, we have our distribution channel, and I could take your product and I could make it available across about 200 retail outlets that will be interested in having your product. We believe by doing this, we will increase your revenue, not by 10 or 20% like you're forecasting, but we're going to increase it by about 50%. So we have a real, we're still interested in investing in you, but we have a real value added that we could bring, and we could even size it and how much incremental revenue and incremental profit we will bring to your business. Now, in return for this, although we have agreed on a valuation of 1.5, we believe that what we're bringing in is worth about $200,000. If we look at over a 2-year period, we will estimate it, we will do, and then what we do is we negotiate to have a lower valuation because of the incremental value that we're bringing in terms of either opening doors or helping you in terms of your technology or whatever it is. So this is part of the negotiation that you will have it in your term sheet. If there is, because there is in kind, take the example I've mentioned, Flat 6 Lab. Take the example of Flat 6 Lab. When Flat 6 Lab invested, I mentioned that they invested 150K. Actually, the amount of cash in the 150K was about 50% of this. The rest was in kind. So they valued the training, they valued the coaching, they valued all this and say, look, you have been going through 3 months, and these in-kind services, we're going to put them as a cash investment as we have done. So instead of having 5% share, we end up with 10% share of the company. So Tanya, your question is very relevant. This is part of the negotiation. Now it all depends on how well you can quantify this contribution that you will do. Okay, so did I answer your question, Tanya?
yes, thanks a lot.
Okay, all right. So now what are the different fund? Why I'm mentioning this? Because in every one of these funding rounds, there's going to be dilution. Now, why is this important? Because if we get to fund, I don't know, a Series A, and we went through 4 funding rounds, and we find ourselves with the shareholders coming from 50% each to going down to 5%, we will say maybe at this point, the shareholders are not as motivated, although the value of the company would have increased. So we always want, as investors, to protect the interest. It might sound conflicting, the interest of the shareholders, the old founders, because we want them to be motivated. Actually, let me check to see if Ziad has come in. If not, I'm going to give him a call. Just 1 second. If not, we're going to go to the next one. So we have, I'm checking my WhatsApp. Sorry for this. All right, let me continue on it. This is great. Okay, let me continue on this. So we have, I'm just listing them to see. I'm sorry for just the logistics. We take a 1 minute stretch, just 1 minute, and I'll be back with you. Okay, let me continue on it. So these are the different funding rounds. So it's important that you understand them because there is going to be dilution moving from one funding round to the other, and we want all to protect the interests of the shareholders on these during these funding rounds as we go through one. So these are the different ones. For those who have not gone through the valuation, typically pre-seed this is accelerator. What we do is agri-tech, clean tech, impact rise, speed, flat six slab. They're all pre-seed funding that we have on average between 10,000 to 100,000. The seed funding, this is the, again, it could be the 4 Fs, which are family, friends, the fools, and the, I forgot the fourth F, family, friends, and the founders, of course. The business angels, this is where Cedar come in. So we have, so the Cedar are here to be able to provide funding, typically between $100, $300, $400,000. So we get, so our friends from Clean to O will probably get about $200,000 to $250,000. The post-seed funding, this is the early stage VCs, $500,000 to $2 million, and we have a number of those in Lebanon. The Series A are the big tickets. We've done a few of these Series A on it, and as we move from one funding round to the other funding round, the risk level of the company reduces. I'll share it to you on the next slide. So what we have is, so we have, so the typical funding round, you have the seed investments, which I mentioned a few of those. Then we move to Series A, which is proper funding round. These are much larger companies with a proven track record, ready to scale. And Series B and Series C are really for scalability. So these will be, so how do they look like? So if you look at these different funding rounds, the family, friends, the founders, this is where your cost of equity or the expected returns are going to be very high, because this is when your risk is the highest, and this is where the valuation is the lowest. So, so there is very high expectation for those who come up front to get high returns. As we move to accelerators funding, to business angel funding, to VC funding, you see that the cost of equity, or the return expectation from the investors, go down, and it goes down to 10%. When you are a publicly listed company, if you look at the Dow Jones or the S&P 500, and you look at it over a period of 50 years, you will see that the average return is about 10%. So this is where you would get it. Now in emerging economies, it might be a bit higher because you have the country risk on it. But these are typically, and in Lebanon, the VCs, you look at about 20 to 30%, depending how much of a social impact we're looking at. So this will be the cost of equity. Now, why is this important? Because this is what is going to be used to do your discounting when we do discount cash flow valuation. The more risky you are, the lower is going to be the valuation, because your cost of equity or your cost of capital is going to be very high. So the risk goes down. As you move from one phase to the other, your valuation goes up, and the amounts that you raise will go up from one round to the other round to the other round. So you have these different rounds that takes place. Okay, so it's important to understand, because this goes into your valuation. So this is the first one, is on valuation. The second one was on the cap table. So the cap table that I showed you is an overview of the total capitalization of the company. What it means basically who owns how many shares. So we own, so Leah and her co-founder had 50%. After the VC came in, they moved from 50% to 40%. If they go through another round, they might go down to, I don't know, 30 or whatever it is. So the capitalization table tracks the shareholder equity distribution among the different shareholders. So how many shares do they own? What percentage of the overall shares would they own? This is the cap table. And the cap table will also be mentioned in the term sheet. The funding rounds would also be important. Why? Because we will always look at what are going to be the funding rounds in the future, so as to also define what is the most suitable valuation. So a number of, we as for instance, Berytech Fund 2, Samar, you could ask the question, but when we look at the different funding rounds, let me check where these are the funding rounds. We even project what it will be on the fourth funding round, and we want to maintain the shareholding position to a minimum position. So in some ways, we are doing the valuation of the company backwards. We look at if in 3 funding rounds, we want the shareholders to get, let's say, 20% as the minimum shareholder stake, what should be the valuation today, knowing that we're going to go to 3 or 4? So this is another way to do the valuation, which is quite important. So understanding the funding rounds when we do is quite important in the term sheet, because it will influence the way we structure the term sheet. Now, what are preferred shares? You will typically, when you start, you will have A-class shareholders. So normally these are the founders, and you will have, or the original shares. So when they start with A-class, and then you have what we call B-class shareholders. They have less voting rights than A-class shareholders. Why? Because they came later. So we, as initial original founding board, we might have more rights behind it. The preferred shares are typically issued to some investors that could come in even after Class A or Class B. And they say, look, because of our strategic importance, we want to have not regular shareholders, we want to have preferred share, which gives us typically more claim to the company's asset than regular shareholders. What does it mean? It means that if we are diluting the company, or if we have a liquidation event, I want to be paid first. I'm a preferred shareholder, I want to be paid first, and then the other shareholder would be. So you have to negotiate those and push back wherever you can. So it's important because you will have preferred shares in term sheets. Liquidation preference, now we're getting technical, so if you don't get it, don't worry about it. Liquidation preference gives the investor the right to take out money before any other shareholders. So it's similar to the preferred shares, but here we specify a certain what we call participation liquidation preference. So this is 2 types, and the participation, and we give it, and it's typically 1x. What does it mean? It means I've invested $100,000, I want before the others, if there is a liquidity event, if somebody comes and buy the entire company, I want my 1x, mean my $100,000 to be paid upfront. Give me the 100,000, and then depending on what my shareholder is position, I will then share with the other shareholders whatever is the respected. So this is a liquidation. So this is like a premium that you get on top of your normal shareholding position, because you have negotiated this liquidation preference. And you have two types. You have participating liquidation preference and non-participative liquidation preference. I don't want to get into details at this stage. Happy to do it on a one-on-one basis. So these are some of the clauses regarding to the other clauses are the ESOP. Now, why is the ESOP important? Because you want to keep one of the issues that a number of founders have is that they are, today they might lose their company, their employees. And some of these employees are typical critical employees, and they want to make sure that they can retain them. So how do you retain? You move them from becoming employees to becoming shareholders. So you give them the option to be a shareholder. And it could be for 0.5% of the company, it could be for 1% of the company, depending how important. Now, typically, if a new investor comes in, the new investors know that you're going to have some employees that are critical, and they will need to get some shares of the company. And the investor will say there's going to be 5 to 10% of the shares that will be left and dedicated for the employee stock option program. But the investor will say that those are going to come from the founder's equity share. So they will force the dilution on the equity, not only how much money they're bringing in, but a percentage of whatever, 5, 10%, it could be as high as 20% in some cases, if it's a large company, would go into the ESOP and will go as a dilution from the original employee share. So this is something that's important. So you need to understand what it is. You need to understand how to negotiate it. So if they ask for 20%, clearly you don't want to be diluted 20%. If they put the money and on top of this get diluted 20% because of the ESOP, it's going to be big. So you have to negotiate this clause and look at it, and look at the employees, look at normally how much salary they're making, what will make them motivated. Is 5% enough? If it's not, what is in the amount? So this is an important one because it will be also in the term sheet. The anti-dilution is something that you have to push back if you are the owner of the company. It's people would come and say, I don't know, I talked to Sabah, I'm putting $100,000 in company, I'm taking 20%. I know you're going to go through different rounds, but since I'm the first one to invest, I want to have an anti-dilution clause. My 20% will remain 20%. So even though you're going to have another, for at least one round, I might push for 2 next round, and I want to have an anti-dilution on it. So you have to be very careful, because if you keep the anti-dilution, it means that you as the original shareholders are going to be severely diluted, because the other investors will not move in terms of dilution in case he or she does not invest with it. So anti-dilution clause will be found. You need to push back, and you need only to accept it if you have no other choice. So and you have 2 different types. I don't want to go into the detail of it. You have what we call the broad-based weighted average anti-dilution, which are the standards, and we have the full ratchet anti-dilution clause, which are to be avoided at all costs. So what is it? It's to protect the investors from dilution in case the company issue new shares in a later equity round at a price which is lower than the price paid by the investor in a prior equity round. So this is anti-dilution clauses. And the last one that I want to mention are exits. This is probably the most important one. In the exit provisions and in the term sheet that I've sent you, you will see it very clearly. The investors and founders generally want to work towards a successful exit if of the company they co-own. And normally what you do as a time perspective might differ between the 2 parties, and most investors must legally exit within a specific timetable. Investors would include an exit clause in the term sheet to force an exit as and when they want it. So they force the exit. And you will see in the term sheet that I sent you, and they would look at the exit based on a multiple of their forecasted revenue when they signed the term sheet. So in some ways, whatever happened with the company, the minimum exit is going to be a multiple of this operating profit forecasted. This is what we call a forced exit that they have it, and we'll go into more detail of it. But this is very important to to make sure that you control and make sure that you are working. Let me check. Is Samar or Mark on the call? If you are, please let me know. Do we have any? Is the IDAL person
on the call?
Mark, you're on the call. Very good. I'm going to stop at this stage, and I'm going to pass on. I'll introduce Mark. I introduced him briefly. So Mark is the founder of Atelier du Miel. He went through a couple of equity rounds, and he went also through one debt round because he get debt funding and he get a couple of equity funding with different investors, IM Capital being one of them, and he had other investors that are being played. So I've asked Mark to share with us what's briefly his company. Also, because we're going through crisis, what are the 2 or 3 things that he's doing to address the crisis? And the last one is what is his feedback and learning process on the equity. So Céline, you're also here. Very good. So Mark, you want to start, and then we're going to pass it on to Céline. Thank you. Go ahead, Mark.
Thank you, Constantin. And thank you for the introduction. Basically, to give you a quick idea of Atelier du Miel, we launched at the end of 2013, and it was just a passion because we were amazed by nature and the bees. Today, basically we founded a company that produces honey in multiple ways, but that basically looked at honey in a new approach and proposed innovative ways to reintroduce honey in the market today. The fact that we did not have anything to do with honey earlier was actually our biggest advantage because we had a fresh eye. And we designed, we introduced many innovations in this sector, especially locally. We introduced a production system that is totally in line with the local environment. So we move our beehives to follow flower blossom, which allowed us to produce more than 30 types of honey from the 4 seasons. We also introduced honey in the gifting market, and we were able to compete with international brands, so mainly corporate gifting and personal gifting, and we were able to compete with brands that were that had been there in the market for a long time and that used to import products. So we actually replaced an imported product with a local product, we also introduced innovative approaches, especially the honey as a service, which is a product that is, it's actually a service that is gaining a lot of traction lately. So we help people produce their own honey in their own gardens, and we get paid a service. And it's a recurrent thing, and it's a very sticky program where customers renew every year. Strangely enough, it's transparent, it's fully customizable, it's done in your own garden, and strangely enough, it's cheaper than if you're buying honey from a store. So today we operate more than five stores locally. Well, today is yesterday. Today all our stores are closed because of the corona pandemic. And we have we have more than 20 employees and hire more than 30 local beekeepers and artisans. Just to go quickly into the situation today, I'm sure many of you are wondering if we're doing the right thing today, if we're addressing the situation. So sharing our experience could be valuable, and we could also get information if you have any insights. So basically, the situation in Lebanon started deteriorating long before October 2019. So we felt the economic hardships. We even felt the financial hardships. Banks had stopped. So for example, foreign transfers long before October, you had to put cash money to import from abroad. There was starting to be a difference between the dollar and the LVP in the banks earlier as well. So. But we all along 2019 we were doing small measures, right? Because we didn't know how big was the problem? We felt that if we do if we change certain tactics in marketing, or if we change certain like small tweaks in our business, that would solve it. But of course, that wasn't the case. And actually, the October incidents in the country helped us understand that we needed to take the tough measures. So what the situation was then and what it is today is that all our shops are closed. The corporate revenue stream, which is a sizable revenue stream, is completely decimated. So we can say that today we live in what we call a VUCA environment. So it's a vulnerable environment. It's an uncertain environment. It's a complex and ambiguous environment. So this is a term used by the US, that was invented by the US military while operating in Iraq, and all our operations need to be designed to address such an environment, and we should be aware that volatility is here to stay, and uncertainty, complexity, and ambiguity are here to stay. It's unfortunately we live in this kind of environment. In some places it's more severe than others. So here in Lebanon, it's maybe one of the most severe today. First thing we did is understand our situation. Understand our get financial visibility. So what is our cash situation? What is our runway? What are the scenarios that may happen? So this is first thing we did. Second, is that to get, and this is an important note, it's not it's under the financial visibility. Today, I think we should be quick in moving all our budgeting, all our pricing, and all our forecasts into local currency, because not everything will be affected in the same way. So we can, I'm sure all of you had budgeted in dollars, so and had priced, created their pricing in dollars maybe. So today rents are going to be affected differently than insurances and than salaries. Everything will be affected, but each field is going to be affected differently. So having we cannot get financial visibility today if we're budgeting in a foreign currency. So unfortunately, this is we have to go back, and this is time consuming. Second, strategy, and it's very important to understand that we need to think of our strategy more frequently than we used to think before. It's not that it's going to take more time and less time for execution, but no, it's to think of the strategy, because we need to adapt. And so identify the streams that are relevant today. So for us, it was e-commerce, export, franchise, and the host program. And based on understanding that what are the streams that can still be operating today, for example, retail is completely down, and it's going to take time before it picks up. Corporate as well. So based on this, we have to redesign our strategy. On the contrary, for example, e-commerce is a great opportunity. The e-commerce outperformed by 4 times in the previous months, and this in March and April. So so there are some opportunities as well, and we can benefit from those in the future. I mean, I would, for example, not paying rent would be great, and not paying a lot of personnel to operate a store. This would be great for us. So moving into e-commerce is an opportunity. Moving into home growing, which is the host program, also we more than doubled our customers from last year to this year, because people are interested in home growing their own produce and seeing what they are consuming and all of this. So this is also, so I'm sure we can find a lot of opportunities. So based on this, also concerning strategy before moving into costs, we have to stay. So what we try to do is stay focused on the customer. So yes, if we have to increase, we haven't increased our prices yet, but we will, because we're pricing, everyone's paying in Lebanese pound. So Lebanese pound is devaluating as we speak. So, but how do we reset our prices? So we have to keep our the customer in the in the first place. How can we? Okay, let's say we want to increase our prices, but how can we compensate in some other way? What is our real costs? How our costs are affected, so that we really keep the customer at the center of our strategy, and not think, and how can this company just survive? Of course, we have to think about this, but we also have to think in terms of keeping our customers and keeping them happy. Okay, and at the end, strategy cannot be not aspirational. So as we need to survive, and but also at the same time, so I'm sure our companies today are much more developed than when we started. And when we started, it was much aspirational. So nothing forbids us today, or nothing blocks us today from being aspirational, even though things are shrinking, market is shrinking, and we have difficulties. So how can we be creative and aspirational, innovative, trying to adapt to the situation? I mean, this is very important to motivate ourselves, the team, and voila. And finally, in terms of cost, like some quick things that we did. So first of all, we restructured our teams to adapt to the revenue streams that can thrive. We renegotiated rents. All the landlords are willing to renegotiate rents at like very good terms. We did not lower salaries in the first period. During Corona lockdown, what we did is that we did reduce salaries. However, we offered some perks. So, for example, pay off days, and then we'll see later if we can give back holidays for the team. So, in order, because I mean, the last thing that we have is the motivation of our team. This is what will keep us alive, and this is what will give us the ability to transform and to move on. But yes, what are okay, we can lower salaries, but what are the perks that we can offer to our team so that they can still be motivated? So, for example, if you have dollars at some point, maybe for them it would, because they used to retrieve to withdraw a certain amount of dollars. So yeah, you can do this kind of stuff to keep the team motivated. And most importantly, once we have this strategy, we went to our shareholders. The transparency is very important. We laid out all the scenarios. We discussed together what are because it's very important to have like a strategy and a way forward that everyone agrees on. This will remove a lot of blockers in the future. So once everyone is aligned on the strategy and we have clear things to deliver on, I mean, this is very helpful. And fortunately enough, our partners were supportive, and voila. Just to give you an idea, IM Capital, which is part of Berytech, is on Atelier Dumer's board, as well as Dian Foundation, which is an impact fund, the Lebanese impact fund, that invests in green initiative and social initiatives.
Mark, I'm going to interrupt. I really appreciate the feedback. I want you to focus maybe for a couple of minutes, since you had different investors on board, and since the topic, as you know, is on term sheet, but I think your contribution on the crisis management action that you're taking is also of value. Can you please comment on maybe one or two learnings that you have in terms of your negotiation in your equity rounds? Can you share with the audience 2 or 3 learning points?
Absolutely. So basically, I will talk about, I'm going to talk about, I'm not an expert in this field. I'm going to talk about my experience in two steps. First one is the seed funding. So when we started this company, the founders, and I'm going to tell you in each step, what are the main things that one can pay attention to, because those are the things that we faced. One is when we found the company, there was no term sheet. However, there were certain agreements between the shareholders, but things evolve over time. It takes a lot of, some people are demotivated, others are more motivated than others to create, to really create the company and move with it. So basically, you'll always need to reassess work versus money injected. And this is something that so you don't want to reach a place where I've worked more than you and he worked more than him and all of this. And this creates blockers, especially before actually setting so this acts mainly before you go to reach out to investors if you want to grow the company. So better have your grounds settled with your founders and early investors on this. Okay. If I'm not clear, there's a few minutes for questions later. Okay, second.
You need to keep it short, Mark, so that
yeah.
to be able to do the questions. So please, another 2 minutes, not more. Thank you.
Yes, yes. So second is when we reached out to our first investors. A few ideas is that you always believe that this time you get the investment and then the company will thrive and grow and scale on its own. But as you get new developments through time, you'll see that you need to invest in the company to grow it, to be able to be competitive and to grow in new markets so always consider this your first round as a first round, and maybe in a year or 2 years you'll need a second round later. So this is why take all the time on your term sheet and to understand all the terms related to this term sheet and the technical terms as well. Because later you will not have time to, you'll be very much taken by your company and by your operations, that you'd have little time and little resources to go back and rediscuss terms of the term sheet. Second, when choosing the investors, the vision is very important. So one, understand if we are aligned on the vision. Second, if we are not aligned, it's fine. Maybe it's the only solution today to go with this investor. But how can we, when we reach a place where we have separate visions, how to address it? And I'm going to give a complete examples. So, for example, the earn-out. Okay, the earn-out is something that, so for example, if you're not agreeing fully on the valuation today, investor may tell you, okay, we are willing to give you a bigger valuation as long as you can deliver on these KPIs, because this will create more value for us and for you. So that's great. This is a very good approach to tackle discussion on valuation, to find solution for different visions on valuation. But the earn-out can sometimes be not aligned on your vision. So they might have different KPIs from yours. It's very important that the KPIs are common and are things that are in your strategy. Second, the discount rate. So usually you have a valuation and then you have a discount, and this discount comes from the input that the investor is putting in the company. So let's say he can help you do market access. He will say that for this participation, I'm going to get a discount rate on the valuation. So be sure to put KPIs for this discount rate. Okay. Thirdly, how can we leverage their capabilities? So sometimes, in terms of legal legal capabilities, they are much more developed than the companies. So how can we leverage this? Not only legal, but on many fronts. Marketing, do they have, how can we leverage their assets and capabilities? And finally, the relation between the board and the company is very important. How can I choose the people on my board? So spend time on choosing people on the board that can be helpful in terms of growth for you. Okay, so I think this covers my personal experience. I'll be more than happy to get any questions.
Mark, thank you very much. I appreciate the time on it. I know you have a lot on your plate, a lot off your shoulders. Maybe I'll start with one quick question. In terms of when you went back to the shareholders and you revised your cash flow forecast, did you approach them for more equity injection, or did you manage the cash flow gaps within your own working capital and OPEX optimization? How did you go about matching or reducing the cash flow gaps that you faced and you will be facing over the next few months?
Well, it's a combination of the two. We had a plan a plan to survive and to shrink the operation to be able to bridge a big part of the cash flow gap. And we also, because we had projects that we were doing, especially in terms of franchise and in terms of developing the moving hive revenue scheme, and that needed some kind of investment. So at the same time, we don't want to lose what we've built, and at the same time, we want to invest in to keep the aspiration of the company. So we developed a plan. It was not only this is my cash flow gap and this is what I need. No, this is what I did in terms of cost reduction. This is what I need to keep the company afloat, but also to let this company get access to new opportunities. And would you be willing to bridge the remaining gap with us? Voilà.
Thank you.
Was it.
Thank you. Any questions from the team, from the audience to Mark? By the way, he has the best collection of honey across so many different flavors and nuances, and I strongly encourage you to go and visit his workshop. This is where they produce it. It's also he has the chance to have his mother and his grandmother also contributing in the workshop. So this is really a 3-generation family, and his kids, I'm sure, are spending a lot of their time in the workshop. So it's wonderful to see these family businesses flourish and grow. Any questions to Mark before we thank him?
I have a small question.
Tfaddali.
Hi, my name is Assil Ahmeen. I wanted to ask Mark that I've heard since COVID-19, a lot of people are making sure that they have enough honey in their home because it really boosts the immunity and it's a good, natural way to take care of oneself. So I was wondering, did you have like more deliveries? Are you working more throughout this crisis?
Yes, we had a lot of purchases motivated by health benefits. So we know this because of customer support. We did have an increase in sales on the e-commerce side. Yeah.
Okay, thank you. That's it.
Any other questions? Mark, thank you very much. As usual, very receptive. Good luck to you, and we keep our stock of honey here too. As I'm convinced also, like Assil said, that this has a lot of benefits during these pandemic times. Thank you, Mark.
Thank you, Constantin. Thank you.
Very good. Okay, now I'm going to ask Celine. Amira and Celine are on board. Both of them work for IDAL. So as Celine, we need to be tight a bit with the time. So really limited to a maximum of 7 minutes, so that to allow times for Q&A. IDAL, sure, as I mentioned, is helping a lot the ecosystem. And one of the major contribution is the setup of this platform that will be connecting companies like yourselves with investors. So who is talking? Is it Celine or is it Amira?
Hello, this is Celine. Amira will not be able to present, so I'm replacing her. Can you hear me well?
Excellent, no problem. You can share the screen in case you have slides. You can go and share them. So,
Yeah,
or
I
if
just
you want to
want to.
talk, as you wish.
I just want to share my screen, the presentation, the business
Go ahead.
matchmaking platform.
Go
Can you
ahead.
see it? Can you see it now? Because I
Not
already
yet, not yet, but I'm sure it will come.
share screen. You cannot. You cannot start screen share while the other participant is sharing. So I think you need to.
Okay, so I will stop sharing. We're getting into the technology. This is great. Okay, so this is new share, post shares. So I will say post share. Try now.
Still, you cannot start screen share while the
Okay,
other.
then I'm going to, Shaheen is still on the call, who else do we have? So because I stopped, hold on, maybe on the more records, no. We have, okay, look, what I'm going to do is, I don't know how to do it. We will, what I encourage you is to be able to discuss it. So don't mind the slides. We will forward
Okay.
the slides to the participants. Go through them if you want, Celine, it would be great. Thank you.
Okay, great, no problem. I don't know if everybody knows about IDAL. We are an investment and export promotion agency. We're the National Investment Promotion Agency. And I would like today to present for you our latest service that we're going to launch soon. We were supposed to launch it actually in April, but because of all this virus outbreak, we had to postpone our plan. So it's a new business matchmaking platform that aims to help connect SMEs in Lebanon with a pool of vetted investors, whether it's funds or individuals from the diaspora, regional or even local investors. We have done already a lot of roadshows before the COVID outbreak. We met lots of companies, and we have lots of interest from companies to be on our platform. We already have around 25 companies with like investment ready, with complete profiles. And we are also doing outreach with investors to start this matchmaking. In brief, I will just start that this platform is an initiative, the latest initiative of IDAL. We're doing it in partnership with the other stakeholders. One of them is Smart ISA that are helping us with the startups. So this platform will not only be for startups, but also SMEs. The platform will be managed by a high-level steering committee that will be chaired by Dr. Mazen Swed, our chairman. And there will also be a selection committee that will decide on which companies that can go on this platform and which cannot. And there will be a platform team that will work directly with the companies to help them develop the company profile, or what we call the teaser. We expect that like entrepreneurs have a lot to benefit from by joining our platform. They will be able first to save money and time, and we will be able to facilitate the process of raising capital and make it more cost efficient. The companies will be able to work with a professional and unbiased team that will help them strengthen their company profile or teasers. They will be able to access third-party high-quality legal and financial advice. They will become visible to a large pool of vetted investors. They will be able to track down interest from investors, and hopefully they will be able to find strategic partners to help them grow and expand their business. The process of joining our platform, we designed it in an easy and transparent way. It should take on average maximum 3 weeks of preparation if the company is ready and they have all their documents ready. So we start, the first step is the registration. Once the platform will be online, companies will be able directly to register online. They will have to fill an application form, and they have to submit a couple of documents. The eligibility criteria to join the platform are also simple and easy. The companies need to be in one of the productive sectors that IDAL supports. So it should be either manufacturing, agriculture, hospitality, or ICT services. The company needs to be established or registered in one of the following legal forms: SAL, SARL, offshore, or holding. And the company should have a business plan in place. So the company should know what is their plan Once an application is submitted, the platform team will work with the company and start the due diligence process. So our process is like we do an in-house screening as well as third-party due diligence, just to make sure that everything is right about the company. We review all the information. We do some background checks on the founders. And we do a high-level financial and legal due diligence to make sure there is no fraud, history of fraud, or anything. And following our due diligence, the selection committee will either approve or reject the applicant company. When the selection committee approves the applicant company, we publish the company profile on our platform. And this profile is only accessible to investors that are registered on our platform and that sign a non-disclosure agreement. So the profiles of the company will not be accessible to the general public. There will be just a very small teaser for general users that open our website. But once an investor wants to know more about the company, then they need to also fill a form, an application form that will be reviewed by us. And he needs to submit some documents, and then if we approve his application, they can access all the information on the companies, and they will be able to do an advanced search by sectors, search by years of operation, by region where the companies are, and they will be able to screen all the opportunities available. IDAL will act as the facilitator between the investor and the target company. So we will follow up. If an investor has any question regarding a company, they can send us all questions, and then we send them back to the company. We will encourage the company to answer as much possible questions. And then if there is real interest, we will also organize meetings, like offline meetings between the investors and the entrepreneurs. And once an agreement is reached between the company and the investor, then the company profile is removed from the platform. So we do not remove a profile after a certain period. We're not a crowdfunding platform. We are just a business matchmaking platform. And this is open also for companies that want to raise either debt, equity, convertible debt. So we do not put any restrictions on this. And also we expect there's lots of benefits for investors to join our platform, because also they will access reliable information. We will facilitate their screening process. They will be able to work with a professional and unbiased team. This is also especially important for angel investors and individual investors that are not like funds or private equity firms that would need help in assessing companies or evaluating companies. They will also be able to access third-party, high-quality legal and financial advice. Yes, so this is it. If you have any questions, I'm ready to answer them.
Thank you very much, Celine. Look, I have a question. I'm interested because typically when you do this facilitation, and I think, by the way, it's a wonderful initiative, and I really wish you and your team all the best, because it is needed in Lebanon. We do it with Cedar in terms of business angels, and we have a number of companies that we are looking into funding. But I think to have it done through a platform is great. How do you go? Do you take any fees in case a transaction is closed? Let's say I don't know, Raja Abdallah, who is on the call, decided to invest in company A. He decided to put $100,000. They went and they done the term sheet and they completed the project. Is there any compensation to cover your expenses, or you provide it free of charge?
Now at this stage, no, we did not decide to put any fees, success fee, but Dr. Mazen Suede mentioned in one of the roadshows that it could be a possibility to help in financing IDAL, since now we have lots of fiscal problems and the budget of IDAL is being reduced, and we are a government agency. So it might be, we might take a very small success fee rate in the future, just to help finance this platform and the operations of this platform. But it will be a very small fee compared, to other investment banks or intermediaries.
Okay, very good.
But now, no. at this
Okay.
stage, because we're still at the beginning.
Yes, and in terms of term sheets, do you provide help, or do you have experts that are part of your advisors who could facilitate the term sheet development and negotiation process between your investor and between the companies?
Yes, we have so far investment bankers on board that are helping us in the due diligence. We have also legal advisors at IDAL that will be helping advising companies on term sheets and on negotiations. But definitely the companies need to have their own lawyers and their own legal financial advisors to help them in their own due diligence. So we will be providing this free legal advisory services. But we will not write the shareholder agreement. You know, we will not be involved in the final stage of the transaction.
Okay. Any questions from the audience to Celine on what IDAL is trying to do with this matching platform between investors and investee?
Constantin, can we ask for contact in IDAL, whom to contact?
Yes, please.
Yes.
I can send you now on the chat my email, and I will be happy to answer all your questions. And we can do one-on-one calls later on to explain more the platform, and also I can share the presentation.
Thanks, Celine.
Very good. So if you could send me, I think Amira has my email. It would be great if you could send it. Excellent.
Okay.
Any other questions? No other questions? Celine, thank you. Appreciate the work. Appreciate your availability. Pass my best wishes to Amira, and
Sure.
I'm sure that we'll be collaborating in the future, as we have a number of companies that do not necessarily get business angel funding, but they might be interested candidate for you. So that it could be any cross-reference between Cedar and IDAL. So look forward to it. Thank you.
Thank you so much.
Very good. Good. Is Samar on the call or not yet?
Yes, I'm here, Constantin.
Okay, very good. Excellent. So I'm going to introduce Samar. I've been working with Samar for a long time, for several years. She is a key pillar in the investment team of Berytech Fund 2. As you probably know, Berytech initiated the first VC fund more than 10 years ago. This was Berytech Fund 1, headed by Sami Beidoun, and I'm a member of the investment committee. And then we created back in 2015 Berytech Fund 2. This is a much larger fund. We started with Berytech Fund 1 for about 6 million. This one is closer to 60 million. And for this, you need to be able to identify the right companies, actually go through the process that we've been presenting, the screening, the evaluation, the pre-negotiation, the due diligence. All these phases were basically conducted by the investment team. And Samar has been a key member and with a lot of experience in these different phases. So I've asked her to join. Berytech Fund 2 have invested in close to 20 companies over the past 3-4 years. And we went in some of them with 2 funding rounds, follow-up rounds with a number of them. So I've asked her to come back and to share with us the key learnings from the investment side and the investee side to ensure that we have as smooth term sheet negotiation, due diligence process on it. So Samar, the floor is yours. Samar, unfortunately, you need to talk. I don't know how to unshare my slides.
I think, Constantin, what you need to do is to close your presentation so that I can open mine, and then you can reopen yours.
Absolutely. So Hadi Bidna, so escape. So let's do this. Stop share first. Okay. And then do this, close the presentation.
Okay, great.
Yes, go ahead.
Perfect. Okay. So my name is Samar Hawa, and as Constantin was saying, I work with Berytech Fund 2, which is a venture capital fund created under the Circular 331 of the central bank. It's a $51.5 million fund, and our investments are between 250,000 to 5 million per investment. So yes, 5 million. Our sectors of interest are IT, digital content, industrial design, fashion design, and renewable energy. I don't know if you can see the slides.
We see it. We see it.
You see them. Okay, great. So I will be going through the do's and don'ts for an entrepreneur or a startup based on our experience throughout the years. So basically, you have to, as an entrepreneur, choose an investor that is a good fit for you. You have to know the investment criteria of each investor. You have to do your homework. Do not think funds only. Think of the added value. Think of what a fund can do for you. If they can open markets for you, if they can introduce you to key people, if they can help you with the next round of financing. So that's a key thing. Choose an investor correctly. And that comes to my second point, which is you're going to be married to your fund. You have to keep in mind that you're going to be dealing with the investor for a very long time. And the relationship has to be healthy. It shouldn't be a toxic relationship. My third point is be realistic about your valuation. I know that you want to be the next Facebook or the next unicorn in the region or whatever. You want to be like, it's your baby. The startup is your baby. But you have to be realistic about valuation. This is a major put-off for an investor. Okay, you can be creative in the structure of the deal, but do not overvalue your company. Fourth, you do not give up a large amount of your equity. You have to leave room for future investors. The life of a startup is very long. You have to raise funds millions of times, especially if you are at an early stage. So you will have seed funds, Series A, Series B, Series C, etc. So you do not want to give up a lot in the beginning because that will dilute your share very much. Be careful about that. Fifth, you should make sure that you prepare well for your negotiations, especially if it's your first term sheet. A venture capitalist would have seen 1 million term sheets, but it would have been your first. So make sure you familiarize yourself with the terms. Do things like this. I mean, watch webinars like this. Research, familiarize yourself with key terms. Be prepared. And in order to do that, it comes to my second point, which is retain a good lawyer. A good lawyer will help you negotiate. And if you need other advisors, also retain other advisors, for example, a mentor or whatever, but just seek the help of someone that knows more than you. And you need to be committed. This is very important because an investor wants to know that you will be in the venture for several years. They will probably request clauses in the term sheet that to that effect. So you need to be committed to your venture and passionate about it. You cannot just say, okay, I'll try it. If it works, fine. If it doesn't work, I'll go and get a job. No, you have to be very committed to your venture. Eighth, you have to keep in mind that investors may ask for exclusivity after the signature. So you will not be able to negotiate. So you'll not be able to use this term sheet and go shop around. So beware of exclusivity clauses. Ninth, ask yourself, what are the deal breakers? Sometimes we leave the deal breakers to the end, but no, prioritize them. Go for them. Don't waste time. You might waste 2-3 months negotiating and then go for the deal breakers at the end. Start with the deal breakers and then negotiate. Okay, so if you have certain deal breakers, just start with them first because you don't want to ask for more after signature. That's a total no-no. A term sheet is usually non-binding. Although you've signed it, it's great. You're happy, you've signed the term sheet, but it's non-binding. You should sign legally binding documents later on, which are like the shareholder agreement and other documents. So don't start spending left and right if you just have signed the term sheet. Make sure that you have legally binding documents to spend, okay? Now I'll go to the key takeaways for due diligence, the do's and don'ts for due diligence. The investors will most probably ask for a background check on founders. Don't take it personally. Don't take it that they're intruding or spying on you or whatever. It's just standard procedure, and be careful. Don't let them bust you. Don't let them find a picture of you behind bars on the internet. Okay, be careful. Make sure you're clear on the internet. A second point is build a competent and flexible team. You have to be adaptable to any situation. Who would have thought we would be living a situation like this? I mean, all the world is closed, locked down, no flights anywhere, etc. This is like a surreal situation. Be able to adapt. We got an SMS a few days ago for a liquor store that teamed up with a pub to provide ready-made pitchers for cocktails to your home while you're in quarantine. These are smart people. They adapted to the situation. Be like that. Be flexible. Don't be rigid. Intellectual property is very important. Investors usually ask for intellectual property to be developed in-house, not outsourced. They want it to be owned by the company and not by a person, okay? And they want it to be protected, for example, through confidentiality agreements or registration of patents or whatever. So make sure you have this in place before you go and approach investors. Be compliant from the beginning. Get it out of the way. You don't want an investor to come in and find a huge tax liability or find that you're not compliant with the laws and regulations. Be compliant. Don't run away from anything. Be transparent. Communicate with your investor. Do not keep anything from your investor. This will come and haunt you later on. So just communicate. And this is very important throughout your relationship with the investor. Even after investment, communication, 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 very important. Do not keep anything, even if it's bad. Just tell them because it will haunt you later on. And sometimes investors may ask for like technical people to come in and technical experts to help with due diligence. You have to cooperate. Don't be aggressive. Cooperate. Be transparent. Be quick in responding to due diligence requests. Anticipate the questions. Have your documents ready. Think of what they might ask for. Be organized. And this is key because it gives a good impression for the investor. The investor will see that you are well prepared, that you in the future they can rely on you. Okay, so be well prepared. Have a clear and realistic business plan. You need to deliver on your promises. Make sure your promises are achievable. Don't say, I'm going to sell like $100 million. Be realistic. Like the valuation, be realistic. It's not about, investors are not stupid. They know. They're going to research the market. They're going to research everything. So be realistic. Make sure that you can deliver. And one last piece of advice, if you are refused funding, persevere. Don't give up easily. Learn from the feedback from investors. Stan Lee, for example, the creator of Marvel and Spider-Man, when he came with the idea of Spider-Man to his publisher, do you know what his publisher responded? He said, I've never heard of a more stupid idea. How can a spider be a hero, be a superhero? A spider, people hate spiders. And look where Spider-Man is today. So persevere, don't give up easily. Thank you very much. And if you have any questions, please unmute yourself and ask.
Samar, thank you. As usual, I love the not only the quotes, but I love also the pictures with the quotes. So it shows your continuous creative appeal. This is great. Look, I have one question on it. Now, when you have negotiated these term sheets, did you have situation that because of a particular case, take for instance what we're going through with the pandemic and the financial crisis in Lebanon, where clauses in the term sheet can be adapted or could not be adhered to completely, so as to provide the leeway for the company that you're investing in? Can you give me some examples of these situations, or once a term sheet is done, it's done and they have to stick to it? Any comments on this?
Yes, sure. A term sheet is basically non-binding. And basically, if you find red flags when you do your due diligence, an investor is able to renegotiate the terms. and to change the terms, or to decline the investment entirely. I would not recommend this for the entrepreneur. I would recommend the entrepreneur be sure of all the terms from the beginning and not to renegotiate anything. But the investor will have a leeway to renegotiate in case of red flags. Yes, I think that, yeah.
All right. Look, another question more related to the environment. We hear a lot of, you know, the central bank is going through so many different challenges, so that circular 331 maybe is not on the top priority. Can you update us on what you think over the next 6 to 12 months is the commitment from the central bank in terms of continuing the support to the ecosystem by providing those guarantees to funds like Berytech and like others? And I know that this is more at this stage speculation than anything. Any comments that you could give us on this?
Yes, sure. Basically, from our communication with the central bank, we've understood that they're still committed, but given that our commitment was in US dollars, they will be giving it in Lebanese pounds. So that's the only change. Instead of committing in US dollars, they will be giving it in Lebanese pounds at the official exchange rate of 1,007.5. So that's the only thing. Otherwise, they're still committed. So so far, we know that they're still committed at the Lebanese official rate, Lebanese pound official.
Thank you. Any questions to Samar from the audience? Please unmute your call and you could ask the question. No, Samar, thank you. Thank you very much. I appreciate.
You're welcome. You're welcome.
So we'll thank you, and I look forward to catching up with you on our next investment committee. Thank you so much.
Take care. Okay, bye-bye.
Bye, Samar.
Bye.
Okay, very good. Let's continue. Sydney, are you on the call?
Yes, Constantin, I'm on the call.
On the call. Okay, let me introduce Sydney. So I've been working with Sydney. Sydney is the Chief Financial Officer of Miaho Medical Center. He's based in Accra. And he has been the CFO for several years, and he has been instrumental in structuring term sheets with banks, and the last one over the past few months, he has been working with the board to structure it with the International Financial Corporation, which is one of the most established lending institution in the world, especially for what we call scale-ups in emerging economies. So I've asked Sydney to come and to join us and to share a bit from his perspective, a bit of the key learning points in negotiation with both the IFC and also with another bank with whom he has raised already some capital. Sydney, thank you for taking the time. The floor is yours.
Thank you, Constantine. Thank you. So basically, Miaho, which is the organization I work for, has been around for about 50 years. We are in the healthcare space, and we've put together a strategy for growth, for reasonably aggressive growth over the next 5 to 7 years. The model that we are adopted is a hub and spoke model, where basically we have a central hub which serves more than a few, actually, quite a few spokes around the world and within Ghana as well. What we did was that we had to raise capital for executing this strategy, and the capital raise process was broken down into several phases. The first phase basically allowed us to test out some of the models that we had for the spokes. So we had various models of satellites. In other words, various models of the level of activity that we'll have in each type of spoke. So we have, for instance, we have a health hub, we have an urgent care, we have a primary care, we have a main hospital. And so those were the types of spokes that I'm talking about. So the first phase involved raising $2 million. And that was done about 2.5 years ago. But it was done through a local bank. So basically what we did was we got term sheets from some local banks for the $2 million equivalent. And it was in cedis, which is our local currency. And as you can guess, it was expensive because this is Africa, and the cost of funding is a bit more expensive than in some other parts of the world. And so what are terms of the facility? We had a moratorium. We had a 6-month moratorium on principal and interest, and the loan duration was for 7 years. So those were the terms. And then there were some reasonably acceptable upfront charges. Total of those came to about 0.5% of the amount. There was, because it was a locally raised funding, there was no exclusivity in terms of the due diligence. The due diligence was very, very straightforward, actually. And the key reason why it was very straightforward was the fact that we were actually raising the capital from the same bank that we had been banking with for a while. So we had got a term sheets from our banks that we had banked with. So the due diligence was straightforward because they could see our cash flows. Now, in terms of the learnings, one of the key things that came up within 2 years of raising the capital was the fact that, you know, even though the money was given to us in the CD equivalent on the day of disbursement and the repayment was in CDs, there were still FX issues. There were still foreign exchange issues. The reason for us having foreign exchange issues was the fact that a lot of the inputs for the projects were being bought from outside. They're being bought from the UK, the US, China. All the equipment for the setup were being bought from outside, and they had to be paid for in dollars, which meant that by the time we had to pay for some of them a year or a year and a half down the line, the dollar had appreciated, and then we had to spend more CDs. So that gave us a deficit in terms of what we actually needed to complete the entire project. So that was a key learning for us. And obviously the other key learning was, we always had to, or going forward, we always have to provide for delays in the project because it happens a lot. The project delays do happen because it's not every time that you can predict the timeliness of contractors and other third parties that you are relying on. So those were some of the key things that we learned from that. And the collateral process as well, in terms of the collateral that was used for the facility, it was pretty straightforward. The reason being that because it was a local company that was giving us the funding, they understood our collateral registry process in Ghana. They knew how to structure a collateral to make it straightforward, because you could easily just put collateral against the Bank of Ghana's, just load it against the Bank of Ghana's collateral registry, and then that would be it. You don't need to do too much work because of the nature of our legal system when it comes to collateralization. And also the negotiations in Ghana were not as tedious because it was a local bank, was not as tedious. Okay, so I'll go to the next facility, which Constantin has talked about, which is for the second phase of our expansion. So in this case, what we did was we approached a few DFIs, development and finance institutions, and then we settled on the IFC. So basically, the amount that we raised was we are raising $6 million. So basically what it is with them is because they are giving us the money in dollars, the repayment will have to be in dollars. We do have dollar revenue, which I think is very, very crucial if you are going to make repayments in dollars. But it's obviously important to increase your dollar revenues just to make up for any potential FX changes that come up during the years. So we do have dollar revenues, which will help mitigate the FX risk. The thing about DFIs is that the interest rates are a lot lower. So we got an interest rate that was very was low compared to what we had on the CD. It was about 5% plus 6 months LIBOR. And the duration was a bit longer. It was a 10-year duration, lower upfront fees, and we had moratorium on the principal. We didn't take moratorium on the interest. We took moratorium on the principal. The reason why we did that was to make sure that our gearing ratio and our liquidity ratios were kind of predictable and were stable over the years. We didn't want to accrue any interest on the loan. So the negotiation for the IFC facility obviously took a lot longer than for the first facility, which was a local facility. But to be frank with you, it was quite an interesting negotiation. They were not as rigid as we would have thought, but they wanted exclusivity, like any other DFI. They wanted exclusivity during the whole due diligence process, so they were granted exclusivity. The due diligence was obviously more lengthy. It was very lengthy. There's a lot more that they wanted. They wanted quite a bit of detail. It wasn't just about the financial aspect of it, to be honest with you. The other aspects probably took more time than the financial aspect. So the legal due diligence took a lot of time. The environmental and safety due diligence took a little bit of time as well. They brought in some experts to come and look at our safety protocols and the way we operate here to make sure patients are safe, staff are safe. We have all the history equipment. We have the standards. We've made the safety standards that are required of us for such investments to be made. Some of the things that we need to take into consideration, or the learnings that I got from this was it's always good to know someone or to work your way up a little bit in the ladder to make sure that whoever you are speaking to can either make a decision or influence the decision very, very quickly. So that was important for us. And then you also have to be very wary of the legal costs. So for instance, the DFI would probably come up with a company that would do the legal due diligence, and then you have to bear the cost. You need to know about that. And then the travel expenses and other out-of-pocket other expenses too, you have to pay for those ones. So that's critical. Collateral process, because it's a foreign investor or a DFI, basically you need to bring them along to understand the way the collateral system is in Ghana. So for instance, in Ghana, we don't have freehold. We have freehold, but very little. Maybe about only 10% of our properties are freehold. Majority of our properties are leasehold. And some of the foreign investors don't understand that. So you need to bring them along to understand and accept the collateral. And there were also some things that we need to consider. So for instance, they could easily come up with restrictions on which bank you use. So you probably would have been banking with a certain institution for a long time, and then part of their conditions would be that you shift to a particular institution. And they could also come up with restrictions on shares, how you use the shares of the principals of the organization. So they could restrict, for instance, okay, nobody can dispose of shares beyond a certain percentage, so that the shareholder that they came to meet retain control throughout the loan duration. And bear in mind, there's a loan, there's no equity, so the restriction on shares is kind of strange, but that's what it is. They have that, and they also have restrictions on leases. So leases and other arrangements that you could have with third parties, maybe revenue share, profit share arrangements, they have restrictions on that. So those are the kind of things. So I think that those are some of the restrictions, but the pros that you could get from having an investor like the IFC coming on board is the fact that they come with a strategic mindset. So it's basically they are like a strategic partner to you. It's not just about giving you the money and walking away. They are a strategic partner. which goes a long way. So for instance, you can leverage their global supply chain, people that they know in supply chain when it comes to, for instance, in our case, drugs and consumables, and especially in this current situation with COVID-19, certain PPEs that we need, they've been able to help us on those, along those lines. And obviously they have expertise as well. They have resources that we can tap on. They have advice on the projects that we are looking to do. So these are some of the things, the learnings that I've come across during my engagement with the IFC and the other companies that we've raised capital with. In terms of my final words, I think the most important thing is that before you even embark on this journey to raise capital with either local, foreign, whichever it is, once you're raising capital, you just need to make sure that you have your strategy in place. And then whatever money is coming in and whatever restrictions fit with your strategy, your medium to long-term strategy. And obviously the money that's coming in should be such that your balance sheet can support that money. So those are my final words. Thank you.
Thank you, Sydney. Maybe the last point you might want to comment, because the once you raise funds, the first question that any investor is asking is, what are you going to use the funds for? And you need to have very clear answers to this. Maybe, Sydney, you would like to share with the audience the process that you went through as a management team to prioritize those investments, and we did it over a 5-year period, or you did it over a 5-year period. So can you just share briefly the process in identifying, prioritizing, and quantifying the different pillars of your growth opportunities over the next 5 years?
Yeah, so basically what we did was we did some market research to come up with the various models of the satellites. So basically what we said was that, okay, we wanted to develop our main central hub, which is our main premise, to be a very specialized center where we'll have all the specialist doctors based, and where we'll grow like some of the specific areas. Maybe if you wanted to focus on cardio, we'll have it here. We want to focus on pediatrics, we'll have it all here. So that's where we needed to kind of solidify the center. Now that would have needed some investment. So that was the priority, to make sure that the center was strong to kind of absorb or to support the spokes when it starts springing up. And another thing that we did was we made a lot of changes on our management team. So we changed the whole management structure. We brought in more senior managers to be able to manage the growth and to come up with ideas that would promote the growth. And obviously we had a whole change on the board. We set up the corporate governance structure of the board was totally revised to position us for the potential investors to come on board. And that was very, very critical, because that's part of what we'll be looking at, to make sure that your corporate governance structure is important. Now for us, because it's a family-owned business, it's been around for 50 years, family-owned business, the corporate governance changes were very, very, very crucial. Okay, now coming back to how we prioritize the investments. What we did was we came up with these models, and for each of those models, we did a financial projection. We did a financial model for all the satellites over the next 5 years. So we decided that, okay, we're going to have a primary care, 2 primary cares every other year. And we'll have an urgent care in 2020. We'll have a health hub in 2020 as well. And we'll have a hospital in, let's say, 3 years' time. So we had all of those in our financial projections. And we did, obviously, stress tested all the models to see which ones were the most profitable. In the first year, which was 2019, we built the first primary care and then the health hub. So we tested 2 of the models. And then I mean, I'll be happy to say that we've actually exceeded our projections for those models, but we've exceeded what we thought we would achieve in terms of our EBITDA and revenue targets. So those were key successes for us. And based on that, we had the confidence to actually look at the other models, which we are launching this year, the urgent care, and then some of the other models that will be coming up later on. So basically, we tested the models to validate them. It gave us the confidence. And it was after that we brought in IFC. So that testing process helped us to prioritize what to do. So right now we're prioritizing the satellite rollout for primary care, urgent care, and then the health hubs. Those are the key things that we are doing after putting some money into the main hub.
Thank you, Sydney. Much appreciated. Any question to Sydney from the audience? No questions. Sydney, thank you. We're running a bit short of time. I appreciate all the support over the past year that we've been working together. And good luck in the closing, and also good luck with as a hospital. I'm sure that you're going through all your different phases to manage this pandemic as best as you can. Thank you again, and my regards to the team. Bye.
Okay, thank you, Constantine.
Bye.
Bye.
Okay, teams, I'm going to go. We have half an hour left, so I'll go through the slide again. So this is the slide what we have covered. I'm going to go through we covered the first 3 phases. There was a question coming from Nadine, is when do we put the term sheet? So the term sheet is only used whenever you're going to consider either a debt or a convertible debt or an equity injection in the company. So this is when you do the term sheet. As has been mentioned by Samar, it is non-binding, and this is the prelude to your shareholder agreement. So normally you will have it when you set up your company. You're right, when you set up a company, you do not a term sheet, but you do directly the shareholder agreement. But whenever you're going to get new equity or new debt partners on board, at each one of them, you will have a term sheet. And this term sheet needs to be accepted by the board, as I showed in the slides in front of you. So this is when you put the term sheet. Every single time that you're raising debt capital or you're raising equity capital, you will have a term sheet that needs to be present. Okay, Sabah, do you see the slide or not?
Yes, it is.
Anybody?
Yes.
Okay, very good. So let me go through. So we discussed the term sheet. So as I said, we have economics terms, and I went through the economic terms. We have the preferred share liquidation preference. We went through the funding rounds. We went through the cap structure. Then we're looking at terms related to economics. We went through anti-dilution, the ESOP, and the exit. Now, exit, as I said, were particularly important because if in the term sheet or in the shareholder agreement, you have an exit that is related to a specific number that you, not the actual number, this could create you in a situation where you are forced to buy out the existing shareholder at terms that you cannot afford to have. So this might result in a severe dilution of your position. So this is something that you have to be very careful, and we'll go through when we'll discuss the term sheet. Now let's move to the second category, which are the control matters. So we had one on the financial or the economics, the other one is on the control. What is control is when you have when you're sharing or you're letting go of some of the control points to your shareholders. So the reserve matter is, I haven't discussed it, but if you look at the list from IFC, they had 2 pages in the term sheet of reserve matters. So what are reserve matters? When you move in as a minority equity stake in the company, what's important is you want to protect your investment because you're a minority shareholder. And how do you protect it? You protect it through reserve matters. What are these reserve matters? It's a list of matters or decision points that can only be implemented with the consent of the investor. It means that the owner cannot take the decision alone. This needs, even though he is the majority shareholder. So these reserve matters could be lengthy. So most of these matters are focused on limiting the founder's ability to take cash out of the business. It could be in the capital expenditure, operating expenditure. It could be on the way they compensate themselves, they compensate the direct teams, it could be bonus, or it could be, these matters will be listed even though the investor is a minority shareholder. So founders must work very closely with investors to make sure that the list of reserve matters is reasonable and is applicable, because if every time I'm going to spend $1,000, I have to go back to it doesn't work. So the delegation of authority is a critical issue on making sure that the reserve matters are actionable, because if not, it could cause a number of frustration. And I've seen cases where, you know, the founder said, look, I'm not running my company anymore. I have to go back for every single thing, but these are the reserve matters that he has signed on. So make sure that you understand what these reserve matters mean. Make sure that you understand how frequently you have to go back to your investors if you have to do it. So this is very important. So look at them, understand them, and maybe revise them with a shareholder. The vesting period. The vesting period is when investors come on board, they don't want the owner to leave in a year or in 2 years. So what they do is they put a vesting period. So they control, and they will tell him, look, you can only, if you want to sell or you want to access to your shareholders, it might be, I don't know, 25% per year as an example over a period of 4 years. So for the first 3 or 4 years, you cannot, you have this period is the period where if you want, your share position is locked. When we discussed it with Niaho, with IFC asked to lock the shareholders position for 7 years. So although it's not even equity, it is debt. So they have a lock vesting period for 7 years. So for some of these investors who want to have liquidity events, they are in some ways trapped. So it's important to understand this vesting period and make sure that the shareholders understand what they're signing so as not to be, so this is levels of control. The board of directors is another one who, you know, they would always ask for a board seat on it. They might ask for 2 board seats. You need to be very careful about extending board seats. Extend it to people who have really the ability to add value to the board. Because the boards, you know, all major decisions are taken at the board. These decisions are approval of the budget, approval of the audited financial statements, approval of the major investments. So you want on the board people that you trust, people that can add value, and people that are aligned in terms of your way of managing the business. And board seat is another way to make sure that the control is with the investor. And if, of course, the investor is putting 15 or 20% in terms of the capital, he or she is allowed to appoint a board seat. So you need to be aware of this. Now, tag along and drag along. Again, I don't want to be too technical, but these are exit provisions, and they're here to protect shareholder rights. Now, the tag along is an easy one. Basically, it says that allows a party, typically a minority shareholder, to tag along, means to go along with other shareholders in the events the other shareholders are selling their shares to a third party. So this is an option that a minority shareholder, if the founder decide to go and sell part of the shares, that you can tag along, that they cannot tell you, no, you are not allowed to come. This is only for a specific number of shareholders. So this is tag along rights, you will have it. The drag along right are clauses that can be onerous as they allow the party and minority shareholders at either a price agreed between the parties or at a price offered by the party to be able to exit. So this is quite important because you need to understand what are those terms. What are those terms? What is the price being offered? And make sure that this is not in the detriment of the shareholders. So this is some of the clauses. You had another one that has been mentioned, if you remember, that Mark has mentioned, which is the earn out. Now the earn out clause is a very typical clause. If as an investor, we come in and we agree on a share, on a valuation, and then I take the example that the one that we covered yesterday with Clean2O, and Clean2O says, no, our valuation is $2 million. And we as seeders decide, no, we are not willing to give you more than a valuation of 1.5, so as not to have. And this could go on for a long time. So one way of breaking this emotional discussion between the founders and between the investor is, it's fine. You want a valuation of 2 million? What are you committing? So they will share the financials. So we have the financials. So we say, fine. So if in 2 years or 3 years, you are making what you're saying, you're making your $1 million in terms of revenue versus the 100,000 that you have today, we are willing to give you, so we have no problem with the valuation of 2 million. However, if this is not 1 million, but is 500,000, then the valuation becomes, and we will decide on number 1.3 or 1.5 million. So what you do is you do an earn out. The earn out means that we accept your valuation, but this valuation is conditional upon you delivering on 1, 2, or 3. It could be revenue, it could be number of customers, it could be whatever matters that the investors feel is important. And in case this is not done, then there is a formula that will bring down the valuation. And when you bring down the valuation, of course, at this point in time, the dilution of the founder are higher. So it's important to understand also, because this is used often in the cases of businesses. Now I'm stopping in terms of term sheet. I'll go quickly through investments. So investments in all evaluation and due diligence, the person doing the due diligence is going to look at the risk areas. So I'm sharing with you a way to do this risk. Some of you are familiar with it. And this, we also run it. We run it with the team, and we look, the whole point here is to understand the level of risk that we are taking when we make this investment. What can go wrong, and what could be the potential impact on the financial projections or on the valuation of the company. So what you do in risk assessment is first you list these risks. So what are the risks behind it? You then make sure that you have mitigation plan against these risks. And lastly, you make sure that you implement these mitigation plans. So you could go from high risk areas to low risk areas that you have. And the way you do it is you do it by listing them this way. So what you do is, one is what is the likelihood or the probability that you have. So if it's, and the other one is what is the impact on your business. So, and then you will come up with different colors, from green, which is basically low risk, low probability. This is minimal risk. And you could go to extreme risk, which is high impact, high likelihood. And I encourage you, and this is something that we do with a number of the companies, not only when we are investing, I encourage you to do this, to list your risk areas and then map those risk areas in terms of how many of them are high probability or medium probability, high impact and low impact. And for those where you have high risk or extreme risk, make sure that you have clear mitigation plan. So this is the whole process. And here you have a list of what could be the risk factors that you have. So in terms of financial, in terms of credit, market exposure, in terms of human resource, reputation, business operation. This is a list of the typical risk areas that you might find. And if it's insignificant or if it's critical, then this gives you an idea. It's up to you to decide what is applicable to your company. For instance, with Niaho, IFC asked that we have a very thorough risk assessment. So they wanted to check the different categories of risk that we have and the different mitigation action that we are taking place. So this is an exercise that is going to take place at the same time when you do the due diligence. Actually, the due diligence is to list those risk areas. So what you end up doing, you end up putting the risk categories that you have: strategic, operational, financial. It could be health risk that we have, especially today. You describe the risk, you put the likelihood, high, medium, low, and then you put the mitigation action. So this is a table that you could also use for your own company to do your risk assessment. And it's very, and if you need questions, and when you have shared all these templates, when you share them, you want to come back for the one-on-one, we are more than happy to sit down and discuss those with you. Okay, so we have, then what we do is we look at, okay, I don't want to go into this list. Then what we do is how do we treat it? I'm going to take the questions. I think there was, let me check on the chat. So what we, okay, I don't have it. Okay, no problem. So I'll take the questions later. So this is, and then you do the investment review, and you typically go through this path every 3 months or every 6 months, depending on the urgency of the risk categories that you have on this. So we have covered screening, evaluation, pre-negotiation with the term sheet. We're now getting to the due diligence portion. So in the due diligence, same thing. We're going to go in more details, but here we're going to look at the different questions. So what is the due diligence? Is a vital procedure in acquisition or investment aimed to confirm the validity and integrity of the various aspects of the company. So normally when an investor is coming in, the first element that will be asked is a business plan. With the business plan, there will be financial plan. These are your financial projections. With the financial projections, there will be a company valuation. The whole point of the due diligence is to take these documents and to see whether the assumptions are realistic assumptions, yes or no. And if they're not realistic assumptions, what are the realistic assumptions and what will be the impact on the valuation of the deal? So this is quite an important process. So what do you do in terms of, it could be strategic. You look at the strategic plan, you look at the strategic priorities, operational. They look at your ability to be able to execute on these different mitigation actions or different priorities that you have. We look legally. Do you have any potential suit pending? Do you have any exposure legally or compliance? Are you complying with the tax? Are you complying with the municipalities in case depending on your business? So compliance and legal is an important part of your due diligence. Commercial, they look at your sales model. They look at your number of customers. They look at how do you go about distributing your customers. They look at your distribution channel. They look at the quality of your sales force. Financials, they look at your financial control. Do you have standard operating procedures in place? Do you have the right systems in place? Do you have the right people to manage it? Are your financial consolidation accurate? Are they timely? All these are questions that will be asked by the, so on these four elements, the financial due diligence, the commercial due diligence, the legal due diligence, or the operational, you decide whether you outsource it or you decide whether you insource it. And you will see, for instance, in some cases, like with Niaho, we have outsourced some. So, and we have insourced a number of them. So when do you outsource? You outsource when it's very specialized. So when it's high project complexity on the financial due diligence, you could outsource it. You know, so what you do, if it's a legal due diligence of high project, you could also outsource it so that you have on this. So this is a decision that you do, whether you do it ourselves or whether we outsource it to an auditor, to a lawyer, to a technology person. So if I'm an investor, I'm investing in Sabah's business, I want to check whether her platform is really best in class. So I will ask a CTO that I know, can you please check it, give me your feedback, whether this is exactly serving the purposes. Can you talk to also potential customers and get, this is outsourcing. So I didn't do it myself. But on the financial projections, I have no problem of doing it myself, sitting down with her and validating what is. So this is a decision that you have to take in terms in the due diligence, whether you do it internally or whether you do it externally. And what are the checklists? So these are the typical checklists in due diligence that you will have. So it could be on the general corporate structure. I will send you a list of the questions. We have about 5 or 6 pages. Here it's summarized in this slide. It could be on your marketing sales. They want to look at the market study. They might want to, are you competitive analysis? They want to see how your customers are appreciating. So customer satisfaction survey. They would look at your product, how good, what is the quality of your product? What is the defect rate that you have? So this is all the different topics that they will be asking and diving into. So this is why you need the NDA, because these are very detailed questions. And it's normal that they ask them because they will be investing either in debt or in equity. So it could be environmental, it could be legal claims that you have, it could be insurance. Are you well insured? Are your equipment insured? If you have a factory, are all employees on the HR side, do they all have employment agreements? Do they all have clear objectives? What is the salary compensation structure that you have? So all these questions will come up. So they will go and they will ask questions on all these different aspects. And this is why, and sometimes you don't have the expertise and you will ask somebody else to do. For instance, intellectual property, you need to talk to a lawyer. You know, when you are in contracts, you might want to have also the lawyer. Legal claims, so this is environmental, depending on what those are. So this is typically the due diligence checklist that you will get on it. Let me stop at this stage. And so I know I want to, because we have 10 minutes late, I'm trying to make the best use of the time. So we have any questions that you have from the audience on what we have covered so far? Very silent audience. No question. This is good. I hope you find this of use. I'm trying to make it interactive. I know you're busy, but these are the slides would be, of course, made available. Sheila will send you the evaluation on it, and we'll have the templates also available. So what I'm going to do is there is a question. Go ahead.
Yes. So I just had a question regarding the earnout clause. I'm not sure I understood it very well. So on the earnout clause, given the differences in valuation, would that mean that the capital will be deployed partially, or it will be deployed upfront, and then once if they don't reach the milestones and they will reach a lower valuation, then the equity percentage will change later on?
Okay, look, it's a good question. What you do is you take the example of Clean 2.0. So because you're also on the CEDAR member, so let's say that we stick to 1.3, and they say no, it's going to be 2 million, and we decide no, 2 million is not acceptable. So we have a choice: either we close the deal and we say we're not going in, or we go in and align to their valuation, or this is what we will be recommending to CEDARs who say fine. If we try to negotiate and then went down to 1.7, and we say still 1.7 is too high because we are too diluted, we're putting, let's say, $200,000 in it, 1.7, so post money is 1.9, so we get about 11%, and we think it's too high. We say no, we're going to, or we say yes, okay, we go to 1.7, but you have shared with us that you will be doing $500,000, or let's say $1 million in 2022. So if you do your $1 million, the valuation that we have agreed is fine, and we are fine with our 11% or 12% shareholding structure. Now, if you do 2/3 of this figure, and we'll come up with some sort of algorithm to do it, then the value of the company at the time when we have done it is not 1.7, but it will be close. It will be the 1.3 that we said. So our shareholder, instead of being 12%, becomes 17%. So you act on the clause that you have done, the earn-out clause, and you dilute the the owners by whatever is this percentage point, because they have failed to deliver on the 1 or 2 KPIs that we have specified in the earnout. So the money is released upfront, but then you apply the earnout clause, and we move from, let's say, as CEDARs, from 12% to 17% in 2 years or 3 years down the road, depending on what is the timing and what is the measure that we have agreed. Is this clear?
Yes, it is. Thank you.
Okay. Any other questions?
I have a question, Constantin.
Yes.
What is your criticism and comments on the term sheet that was sent by email?
Okay, I want to give it a fair. So what I'm going to do is, since we have limited time, I'm going to have another session, because there are a few points that I want to cover in the slide set. We're going to schedule another session. I'll check with Sheila to do it next Friday, or if not, we'll find another time behind it and share with you, because this is important that we go through it, and I don't want to rush through it. There are 3 or 4 points that are critical in this term sheet that needs to be understood and needs to see how we could do it. So keep this question, Joanna. We will go after it. We will communicate to you, and we will have a much shorter one, probably maximum 1 hour, and that to go through this, to share with you a bit of the closing elements, and to share also the term sheet. And I will also share the due diligence process that we went through with CEDARs, that we go through with Berytech and the others, so that you are familiar with the templates that are being used. Any other questions? Okay, so what we'll do is we went through the phases. So we have the due diligence. After the due diligence, after the term sheet negotiation, we basically are here and ready to sign the shareholder agreement. Now, the shareholder agreement is the binding agreement. The term sheet is not binding, but the shareholder will be binding and will be including all the clauses that I've mentioned, and some other clauses that you have in the term sheet. Actually, maybe I could go through the term sheet. Let me check. I want to see whether I want to share others components. Okay, what's important is when you make the acquisition, take again the example of CEDAR or the example of Berytech. What you want is you want to make sure there is a post-investment follow-up. And the way we do it in Cedar, for instance, we appoint a deal manager. So there is, for instance, I'm the deal manager of MAD. So this is a company that had been funded by Cedars. So my role is to follow up with MAD and to represent Cedars in whatever board meetings or important meetings. So why do we do this? Because we want to ensure that our investment is protected. Not only we're asking for quarterly updates and quarterly review and quarterly financials, but we also dedicate a person that will be working with this company that we have funded. So Samar, for instance, who presented, will be sitting down and following maybe 2 or 3 or 4 different companies to ensure that all is going well, to ensure that we have clear milestones, clear metrics, that the company is delivering. And on a quarterly basis, not only is the company providing the update to Samar, but also Samar and Berytech Fund 2 are providing those to us as members of the investment committee. So on a quarterly basis, for each of the companies that have been funded, we know exactly what happened the previous quarter. We know what are the priorities for the next quarter. We know what are the key milestones. We know what are the key metrics behind it. And we receive this report on a quarterly basis. So this is done from the company to the investor and from the investor to the investment committee. So, and this is what we call the post, the closing and the post investment, if you want, phase. So this is very important because this is where we realize the value that the investor is bringing or not bringing to the company. So it's important that you keep this this in mind. So this is the post-merger integration. So we have here now you have a plan that you could do after the investments in terms of you decide if there is you have decided on a few priorities you want to track, how you're doing it, from if there is some redundant position, if you're transitioning businesses to a common platform, because we could have 2 different systems, ERP systems, or in terms of the way to effectively communicate to the people and to capture whatever synergies. If we decide to invest in these companies because we think that there are some synergies, we list those synergies and we follow up on these synergies to see what, and of course, communication is clear. You want to ensure that everybody is aligned if it's a merger, because a lot of the mergers fail because of the poor communication taking place and because of the different culture between 2 different companies that doesn't work. So this is quite important. And sometimes we realize that this company doesn't fit in our portfolio, doesn't fit in terms of the way they take decisions, doesn't fit in the way they are reactive to the information that we're asking. So communication is quite important. Now, the same way I've included investments, you could also look at divestments. Because as a portfolio, if you have several companies, at one point in time, you are going to go through maybe deciding that you're going to divest from the company, either because you are forced to divest, if it's a closed-end fund, i.e. a fund that has to return their money to the investor in 7 years or in 9 years, you have to divest, and you go through the same sort of process that you have gone through. Instead of screening, evaluation, pre-negotiation, due diligence, and closing, you do the strategic assessment, you do the planning, you do the preparation, the execution, and the closing. It's a very similar set, a bit different templates that you use here. So how do you negotiate the term sheets? First thing is, in terms of tip, get more than 1 investor. Don't stick to 1. Because if you're 1, you're trapped with 1. Ideally, especially at the first phase, when you are in the talking phase, make sure that you have a couple, 2 or 3, because this will put pressure on the others to come up with a term sheet that could be more attractive. So it's important that you go, you look at potential investors, and you maybe talk to 2 or 3 before you decide to start the process. You need to make sure that you're on top of the clause. I send you a term sheet, you're going to tell me that half of these clauses you don't understand them. So hopefully after today you understand a bit more, but you still have some clauses that you don't. If you don't understand them, get back. Get yourself a legal advisor, this is point number 4, or a financial advisor to explain to you what are these clauses. Because this is, you need to control, point 7 that I have. It's not your lawyer that will be the negotiation. You need to do the negotiation. It's your company. It's your shareholders. You are the main shareholder behind it. So it's not neither your financial advisor nor your legal advisor. You have to go through it. You, of course, need to understand the valuation, because this is going to be a core element in the negotiation. What is the value of the company? and you need to be in a position to defend it, defend your assumptions. If you're not, you're going to be beaten up on this. So this is quite important that you prepare yourself, and we as Berytech are here to help you in this. You need to list and prioritize your negotiables and non-negotiables. This is important, especially in reserves matter. What are the things that you cannot accept? You know, for instance, if they say that every expenditure above $1,000 needs to be approved, you will say this is not acceptable. This is non-negotiable. You know, so you want a minimum of $50,000 or whatever is the amount to do this. So you need to get your list of negotiable and non-negotiables as soon as you get from the investor what is the reserve matters. So from these reserve matters, what are the acceptable ones, what are not the acceptable ones, and see how best to negotiate them. You also need to understand the dilution. Samar came up with this point because you will go through 3 or 4 rounds. We don't want to find yourself with less than 5% of the shares in 3 or 4 rounds down the road. So understand what this impact is and protect yourself for too severe dilution, especially during the first 1 or 2 rounds behind it. Because if you're too diluted, it's going to be a problem, not only a problem for you, it's going to be a problem for the other investors at the same time. Okay, and your due diligence is not one way. Do it the other way. Spend as much time talking. What is, I mean, Samar has a reputation, Berytech has a Fund 2 has a reputation. They have invested in different companies. You can take the phone, call these companies. What do you think? How did it work with Berytech? How much value did they end the process? How long was the process? How proactive are they whenever you have requests? These are the due diligence that you need to do in order to be able to do it. Now, the quotes that I have here is the most difficult thing in any term sheet negotiation is to make sure that you strip it of the emotion and deal with the facts. So what does it mean? It means get your facts right, understand what your facts are, and make sure that you have them well documented in terms of valuation, in terms of reserve matters, in terms of exit clauses, and try to keep your ego out of the business. Because a number of the times, these term sheet negotiation, due diligence, go not in the right way because of the ego getting in and people feeling offended by the questions that the due diligence people were asking. You don't trust me, I told you it's this way, so you go. So keep this in mind as you go through your term sheet and negotiation process. Now, this is a long list. I'm not going to go through it. I will use it after we go through the term sheet. It's 12 o'clock, so I will need to stop. So we will schedule another one. We keep it short, probably actually half an hour would do. I'll review the key elements that we have gone through it. I will also go into the detail of the term sheet because it's very important to go through it. And there is a couple of others that were supposed to speak, were not able to speak. We'll ask them to come. So let's say in an hour we'll be able to do it right. So I'm going to stop at this stage. I want to thank you for your time. I know it was a big of a mouthful. I thought it was important to have also perspective from others. Each one come with a different perspective. You will get the copy of this slide, of the slide that Samar have shared, which I thought were good slides also on it. And IDAL will be forwarding also their slide set. So we will have 3 series of slide set once you complete the evaluation. The last point I have, yesterday I was at USAID office and they taped me for, we did 4 different videos. They're about 20 to 25 minutes each. These videos are touching different elements of crisis management. So these are very focused and so instead of doing it over 2 hours, over 3 hours, how can you squeeze all the learning, all the templates in about 20 minutes, 25 minutes maximum. So these will be online. I will share those with you. It will be followed by other webinars to be able to share best practices across the different members on it. And of course, we're going to have the one-on-one sessions. So we will inform you on this. It will be on the Berytech website. For those who are on my WhatsApp distribution, you'll get them, of course. I wish you a wonderful weekend. I thank you for your patience. Any questions before we close? No questions? Very good. Thank you all. Good weekend. Joel, thank you for being present. And we will be in touch with you over the next few days. Thank you, and be safe and be healthy.
Thank you. Bye-bye.